modules added in for a number of years, and it's always been quite well received. This course is imperative for geologists, mining engineers, and technical specialists who sign off as CPs. As we all know, 2020 has been a year of turmoil, but it's definitely made the GSSA Meetings Committee move the meetings into the digital space. And I think we've accomplished this with some ease. There have been some hiccups as well, though. We only managed 2 physical events before lockdown, and since then, all our events have been online. Tanya started the ball rolling with her CPD workshop, and then we had the PGE webinar, and last week we finished the GeoSkills course over 5 half days. In total, we had almost 400 delegates for that course, which was quite mind-boggling, but it was mostly sponsored by industry and academia, and associations like SACNASP, Windsor, and GSSA also ensured that especially students could attend this event for free. Tanya, could you just scroll down to our slide of upcoming events? Thanks. So you'll see in white, these are the events that we are still going to be holding this year. The 3D geological modeling course, and they're all going to be online, except we really still are hoping that the Technology Day and African Exploration Showcase in November will be a physical event again. So please have a look, and also keep your eye out on our calendar and our website, and you'll see which events are coming up. I'd like to thank our sponsors. We've got two annual sponsors, GeoExplore Store and MaxGeo, and they've been annual sponsors for a few years now. I'd also like to thank SACNASP and the GSSA for being delegate sponsors. And especially, I'd like to thank our speakers. They give their time and expertise to present for the GSSA free of charge, and we really appreciate all the time and effort that goes into this. If you have any questions, we're more than happy to answer them. But with that, I'll hand over to Tanya, who will give some more information on today's course.
Thank you. So we're going to start off on day 1, looking at some of the requirements for SAMCODES. I'm going to stop sharing. Bruce, if you'd like to share your screen. Okay, down at the bottom, there's a big green button. Click on that. Select your presentation. And then the bottom right, there's a blue button that says share. Nolene, if you would just take over for a moment and assist Bruce. I have been ishcommed and I'd need to go and find my generator.
Absolutely. Bruce, at the bottom of your screen, do you see a little green square that says share screen? I can't hear you. You're on mute, Bruce.
Okay, can you hear?
I can now. Okay, so just click on the share screen.
Yes, I have. Host disabled participant sharing screen.
Okay, it should work now.
I'll tell you, you know what? I've got my presentation on a slightly bigger screen. I need to move to the other screen. Oh my goodness. Okay, otherwise just let me bring it back to this. Oh, that's too small.
Okay.
Okay. There's a way to move to your second screen.
When you click on share screen, you should get a number of little icons that come up showing your different open apps.
Yes. Okay.
Just click on your presentation. There we go.
Okay, has that moved it to?
Okay, so we're not seeing
Can
your
you see that?
presentation mode. So
Now,
there should, okay, if you just go to the bottom of your screen now and click on slideshow.
sorry, I just want to see screen 2. Screen,
Okay.
if I click on screen 2, and I should be able to go share.
Try again.
There, it's on screen 2. Why is it not? And I'm clicking on share.
No,
You see the laptop screen.
Okay. Bruce, try again. Go to share screen, and there should be different options that you can choose. So choose your other presentation option, the one that's in your slideshow version.
Yeah, I've selected screen 2.
Are you doing this in the Zoom options, not on your settings option?
No. I clicked on share screen and then this came up. Why is it not?
Nolene, I can see the disclaimer slide.
It is, but that's not any. That's not in the slideshow mode.
Bruce, down the bottom.
There we go.
Put it into slideshow mode.
Oh, it's sorry.
Just to the right of where your mouse is now.
To the right.
There we
Next
are.
one. Next one. There.
Okay.
Just a quick request before Bruce starts. Please rename yourselves so we can tick you off on the registration list. Thank you very much.
Click that one again, please, Bruce.
Okay.
There we go. Perfect.
Thank you. Thank you. All right. Okay, should I go?
Yes, please.
All right, well, good morning, everyone. And thank you, Nolene, for your introduction and also to Tanya and the committee for getting me a little bit involved as what I think is a rank outsider. When I look through the membership of SAMCODES, then someone representing the Investment Analyst Society is pretty much an outsider. And that's a bit of a theme that I want to put to everyone. And I think we need to address it. Just if I can just show the regular disclaimer, like the mining industry, we are subjected in financial services to a lot of regulation. I am not allowed in any way to be talking to anyone, even casually at a braai or a supper, about investments and what to do. So I haven't really covered anything specifically investment per se, but just to accept that there's no advice given today. Right. If you look at my heading here, SAMCODES, what I've said, it's a cold link to investors. And whereas 20 years ago, the JSE incorporated SAMCODES into Section 12 of the listings. So it's been very much part of the investment community for 20 years. And I would say that prior to that, the mining houses used to incorporate all of the SAMCODE related information in documentation that we used to receive. So it's been in the investment community a long time. Why do I call it a cold link? Well, if you look at who participates and who uses the code. So on the one hand, we have owners of mineral rights and projects. And SAMCODES kicks in a big way in that you are able to present very coherent projects to investors. It's comprehensive, technical, financial, marketing information. The merits and the risks are highlighted. Cash flows are provided, sensitivity analysis, and even valuations are provided at the end of the day. So all the right boxes are ticked. On the investment side, who are the big users of these documents? Well, we have lots of local investors and we have global investors, mainly institutions. And then there are, to a degree, high net worth individuals. But sadly, in South Africa, high net worth individuals very rarely partake in mining project work. The other point to understand and take with you is that investors are able to invest anywhere in various sectors, be it in the listed market space or private, local or global. But the one thing is that plays in your favor when you're looking for investors is that local institutions who manage pension and retirement funds are only allowed to invest 30% offshore. So there's a lot of money that is actually captured and held for investment in South Africa. And really that should be your target. The other important point I want to make is that and I'm guessing about pre-2000, excuse me, pre-2000, the stockbroking analysts and the financial institutions were very, very well represented by mining-related skills, be it geology, mining, or metallurgy. And that meant that there was a group of people within this investment community that did understand what you guys put out by way of project work. But post-2000, there's been a big drift away, and you find that the analytical fund management world is completely dominated by accountants, CFAs, chartered financial accountants, and they tend to dominate, and they do have limited technical skills and inherently tend to believe mining projects are high risk. So if we look here locally, and I just make the point that it's extremely difficult to market to people that are very financially bound. But there's a lot of people to market to. So the 4 big banks all have asset management divisions. You'll see the names that I've listed, well-known, Allan Gray, Coronation, the PIC, there's a long range, Old Mutual, Sanlam. There are more than 150 boutique fund managers. There are about 35 mining corporates that are listed, always looking for opportunities. And then there's private equity, venture capital, and to a degree, stockbrokers may have some private clients, but those are days gone by where they had a big batch of private clients. On the offshore, there are just plenty that still invest in South African shares. Now, saying that, it's typically the Anglo-Americans, the BHPs, the big golds and the big platinums, and Kumba, which attract many, many offshore investors. So frankly, there's a lot of people, and you can see the type of countries where these investors have historically come from. Right, I was sitting, and in preparation, I just used Sibanye-Stillwater as a bit of an example for myself, and I went through their documentation. So when a fund manager or an analyst opens up the financials of these mining companies, you're going to look at the integrated report, and you can see the long list of frameworks and standards and regulations that go into the integrated report. Now, the Sibanye-Stillwater 2019 report is actually 264 pages long. So you go through that, and then you pick up the annual financial report, and that's only 128 pages. So imagine now you're a financially orientated person and you don't understand the technicalities of the mining industry. It's unbelievably daunting. And that is why I say there's a big cold link to the investment community. So let's look at where typically a fund manager or asset management in looking at your company for the first time, might pick up the balance sheet and say, well, I wonder what assets they hold. And this is Stillwater, Sibanye Stillwater 2019, December. So you'd look there and the little arrow on the right there shows property, plant and equipment, 57 billion. And captured under that number are all their gold assets. And you will all probably know them well: Kloof, Driefontein, Beatrix. On the platinum side locally, they've got the old Rustenburg Platts, Kroondal. They bought Lon Platts. It's all captured in there. And then they went offshore and they bought Stillwater in the US. And plus they've got some smaller investments in mining properties in the US and Argentina. Now, when the fund manager looks at plant, property and equipment, they think industrial company, property company, manufacturing company, and they think about what their assets might look like. You can imagine all the work that goes into valuing projects and companies is all captured literally in one line. And they will never, never understand what sits behind that line. And so not understanding, you've almost lost them from day one. So what really helped me, and I was maybe lucky, I did come out of the mining industry in the early days and before I got into the investment world, is I would urge you, and I think we all need to go on a bit of a marketing campaign, is use the technology and the wonderful work that SAMCODES members do. If you can imagine showing someone what an ore body potentially looks like, the shape, the dimension, the configuration, and if you look at the chart on the right, and I just said, cast light onto these underground workings. They may have seen an open pit, and that's the closest they would have got to mining. They will have no idea what that ore body looks like, how you're going to access it, the shaft systems that are required, the vent shaft, and then the different haulages, whether you ramp down or whether you cross-cut into your ore body. And plus, if you look at the bottom, the ongoing exploration that takes place down there. To me, these are unbelievably exciting things that are never captured, and they're not shown properly to the investor. And so that's the type of thing I think we now need to do, is to get the investor back on sides. And again, this speaks to it. So if you look at the left-hand side, there's the SAMREC code at work, reams and reams of commentary and procedures and processes and valuation techniques. And that is just unbelievably complicated for the average investor. I'd far prefer to be looking at the right-hand side where you can see all the drilling, and I can now get a feel for what that ore body looks like, and I will understand when you tell me that the average grade is 2% copper or 5 grams per ton gold, and it could vary across that ore body. I can begin to understand that and picture it. So what I'm asking is, let's give life to these ore bodies and these mineral reserves that you've spent so much hard work in evaluating. And this is typically Goldfields in the old days, right at the back of their annual report, used to have 2 slides, one the plan and one a side view through a section of one of their mines. I actually wanted to use Deal Crawl as a fantastic example of how these plans helped me, but I couldn't find my old Deal Crawl file. So I've used Kloof Gold Mine, and you know, I was able to use plans like this to show where the sub-outcrop was at about 1,000 meters below surface. And immediately they would say, well, how can you begin to start mining at 1,000 meters? Now you're getting them involved in the conversation, and you will explain to them, this helps explain what a sub-outcrop is, what strike is, and what dip is. They have no idea. And plus, you can now show that leading off your initial vertical shafts, you could probably mine for 20 years along the strike there. And there's a certain benefit in terms of time to get to the working place and get out again. Once you go to subvertical, which is the next 20-year life, and finally down in the tertiary level, obviously your traveling distances get longer, heat is a problem, seismicity is a problem. You can now explain to the investor and you can bring them on board. So you really need to introduce this exciting, what I believe is a very exciting part of mining. Introduce that. If you look at the side view, you can see the reef horizons. You can see where the sub-outcrop is. Main shafts are verticals, deeper main shafts here, and going down into the 3,000, 4,000 meter deep sections. You know, one of the interesting aspects here is because they were contiguous to Lebanon gold mine, they were able to early access from the Harvey Watt shaft. So they could access from this shaft in here. And that gave them a fast start. Now for the investor that didn't understand that, they didn't understand that if I can bring my cash flows, 40 years of cash flows forward by 1 year, that's an incredible benefit. And so these type of maps and charts and side views are all available. You guys generate unbelievable stuff. We need to get this message across, and this is going to help investors understand how people access the workings, how you bring your materials in, ventilation, and then again, how you move the rock out and get it back to surface. And then they immediately want to understand more about the geology, and they're going to want to understand more about the metallurgy and the extractive side of life. So this is a little bit of work that I've been following for quite a long time, and it came about because so often, and indeed when I was managing a fund that covered African mining, the same issues came up. Is you guys are just coming here and shareholders and project managers are raping and plundering our riches. And you know, the more I thought about it, I think there's a misunderstanding here. So what I did was to take the old Chamber of Mines, Mineral Council today, and I had the data back to 1950. Sadly, this only goes from 1950 to 2015. The council have kind of lost their capacity to generate the latest set of numbers. But anyway, I think this makes the point. So 65 years of data, what I did, and if you look at the bottom commentary here, over that period, so what I assumed is this is one big company, private company that owned all these businesses. We produced 35,000 tons of gold. Total revenue in money of the day was 950 billion rand. It's not a lot by today's standards, but that's what we generated over 65 years. So to me, the important thing was, well, what happened to that revenue? You can see the chart on the right-hand side. 67% went to working costs. 9.8% went to other costs. Included in there is silver credits, uranium credits, etc. CapEx absorbed 16.7%. Direct tax absorbed 6.5%. Dividends about 6.5%. And then there were losses, slightly bigger than the level of dividends paid out. So, you know, when you look at this, and if these businesses were not listed, assume they were just a big private enterprise, you as the shareholder would have had to put capital up initially, go through all the lead time, all the risks of building those mines, mining them, and then wait every 6 months. These companies were really good at paying dividends. So every 6 months you would get a little dividend, and you would wait for 40 or 50 years to get your 6.5%. And along the way, because of the losses, you would have had to fund them, be it by debt, be it by selling the company. you in fact lost slightly more. So where did this notion of that the riches and the mineral resources are being plundered come from? And I think the confusion was because of a lot of people took these companies and they listed them on the JSE. And these mining companies, in fact, helped the local stock exchange grow tremendously. It helped. The multiplier effect meant that Johannesburg was created, our ports were created, our roads built largely on the back of mining. Once you're listed, this is a different game. This is a game where there's a willing buyer, there's a willing seller that will buy your shares. And they don't just look at one annual dividend. They're going to look at the life of mine and try and say, well, what would I pay on a life of mine basis for this company? So they might do a discounted cash flow analysis and come up with a price. Or a lot of people like to just use a simple method of looking at a PE ratio, price to earnings ratio. And if they were very uncertain, they might say, well, we'll give you a 5 PE, 5 years of earnings. If they knew a lot more and they were more confident, they'd give you a 10 PE or 20 PE. What it means is you're not sitting there waiting for your annual dividend. You could realize 5, 10, 20 years of earnings and put that in your pocket and go. And of course, as you all know, commodity prices vary a lot. And there's times when the share prices are decimated. There's other times when, like we're experiencing now, where there are huge runs. And I think people who haven't really thought it through keep on with this notion, but you're plundering our resources. You're not doing anything for us. The stock market is a separate entity. It's a separate game that investors partake in. So, you know, I hope that kind of sheds a bit of thought and debate about that people like yourselves that are generating projects. It's not that the shareholder runs away on day one with a lot of money. The shareholder has got to be really, really patient and absorb a lot of risk along the way. And so where are we today? And I think COVID has made us all take a hard look at what we're doing, how we think we're going to generate a livelihood going forward. And in many respects, I look at global economics, and every single country there were many inequalities and difficulties hitting countries, debt being one of them. And COVID has just laid this all bare on the table, and we really need to now wake up and say, how do we go forward? And I think the members of SAMCODES need to look at the incredible work that they generate. You've ticked every single box that you would want to, and the investor can't ask for more, but you need to go and tie up more tightly with the investor. Now, why is that not happening? It's partly because politicians have got in the way and disrupted the corporate playing field, which has now chased investors away. We really need to look at South Africa. There's a list on the left of some of the major minerals and metals that we've produced. We were absolutely world-class, which I stand to be corrected, but I think in the early 80s, we were probably number 9 or number 10 biggest stock market in the world. So how does a little country on the tip of Africa get to be in the top 10? Because we had an incredible mining industry, and it built an industrial manufacturing and financial base on top of that. So if you look at South Africa, we're just a country of farming and mining towns. Outside of Cape Town and holiday resorts, the ports largely were built to accommodate mineral product. And internally in the country, it's by and large farming and mining towns. So we need to take all your skills and really go back and visit. Otherwise, we are at great risk of generating or moving into ghost town scenario. So I want to just bring you a little bit closer to the stock market. One, just to show you the phenomenal things that are happening at the moment. So the chart on the left-hand side is, and this is index to 100 back in September 1985. I could go back to 1970. The numbers and the charts are not going to be much different. So all indexed in rands. So it's all in a common currency. So from the top performer is the NASDAQ in rands, the dark blue line, the S&P 500, then the JSE All Share Index, and then the FTSE 100, the UK FTSE. And what you can see from the last global financial crisis, 2010, is that NASDAQ has gone ballistic. And that houses most of the technology stocks, the Microsofts, the Netflixes, Apple. Amazon is not in there. Amazon is part of the S&P 500, and that's partly why the S&P 500 has done well. But you can see how technology has just gone crazy. Now, we can have mining stocks that embrace technology, and they are indeed, but we need to bring technology quicker, faster, so that we become very, very efficient. That's what the stock market is looking for. It's all about technology. Otherwise, they're not interested. And you can just see the extreme run that NASDAQ has had. Now, the chart on the right, the chart on the right-hand side is the one I really want to talk to. The gold line is the Aussie in rands, and the greenish line is the S&P in rands. And what you can see is, apart from a couple of periods where there were big currency swings, and that is largely because the dollar either weakened tremendously or strengthened, and we had a big move in the rand, and that would have affected our stock market performance. But until August 2014, the Aussie outperformed the S&P. I mean, that is mind-boggling to think that a little African stock market could have outperformed the S&P. Now, sadly, since then, you can see we've gone sideways, we've gone nowhere, and the S&P has ramped up. And that has been dragged up by the technology. So, you know, we have so much to work on. We have just got an incredible base here. And why have we gone sideways? Because what I call the corporate playing field has been pretty much destroyed, and it's been disrupted. If you were a sportsman or a sportswoman playing golf, playing any sport, you need a proper playing field, and it needs to be consistent. And that is what we don't have. So whilst I think members of SAMCODES need to get to the investor, collectively, we need to be talking to politicians. The riches are not being plundered. So you can see this is just, to me, it was outstanding that we managed to match the Aussie until 2014. But we need to address the problem now. So really, I think the important thing for investors is that SAMCODES has a seat at the world mining table. The type of work that has been done is right up there with the best in the world. That gives investors a lot of comfort. The problem is that policy-related news flow just continues to chase investors away. I mean, the mining charter and the content thereof is just dragged on for far too long. We need 30, 40 years, 50 years of consistency ahead. And that's going to give us a chance of regenerating the mining industry. And the other big cry that I get all the time are from the juniors and the explorers. They're just so overwhelmed with regulation and just trying to keep pace. It's just impossible. we find it in the financial services. As a small asset manager, you can't absorb this pounding of regulation that comes at you. You just don't have the funding to keep going. And so we need to find a way to have codes that everyone inherently live by, and we don't have to question it all the time. And that's just a cry from the juniors and the explorers, is let's find a way to help them. SAMCODES really need to reveal these hidden riches that are sitting behind that PPE number. When fund managers look at that balance sheet, you need to help them understand what is behind that 57 billion in the case of Sibanye. And so, I'm saying that the country sits on the edge of a precipice, and 2 weeks ago, Roger Baxter from the Mineral Council gave a long presentation, and he said, we're not on the edge of the precipice. He said, we are in it. And I think he is right. We are in it. And I feel that the one way back is back to our roots. So back to mining and back to agriculture. The multiplier effect is, no other industry has such a powerful multiplier effect as the mineral industry. So it would be a real tragedy if SAMCODES is just left to its own left to destiny. We need to make our own destiny. And so I would urge members to find a way, and we have been discussing ideas of seminars and talks to the investors, but find a way to aggressively market your skills, the purpose of SAMCODES. Otherwise, what you consider as marvelous will just never be understood. And so we also need to get to politicians and the public at large. We need sensible policy. We need lower royalties, taxes. And I'll come back to my zero tax rate there. If we are going to generate new mines and have them developed, to me, it doesn't make sense leaving ore in the ground. This could be a means to an end, and that means jobs and multiply effect. And I'd just like to throw it in there. I know I've questioned some of you before about, even let's go to the Northern Cape and let's say base metals, no tax. And so most people have said, you're crazy, politicians would never go for it. It's not going to happen. Don't even go down that road. Well, at least one of the CEOs of one of the biggest mining companies in the world listened to me, and he said, I think you're right. And I've had a discussion with them. What if we said zero tax on base metals in the Northern Cape? That might just mean that pay limits would drop sufficiently, and there could be 2 or 3 small little mines. If we just generated one mining town, that's jobs and multiply effect. Otherwise, the governments, we just tell them, you don't like it, you don't want radical transformation, you're going to leave the ore in the ground forever. And as you all know, a lot of you are forced to go and look for work outside the country. So yeah, I'd like to just leave you with that message that, well done, fantastic work, the codes are brilliant. You need to market yourselves to the investment community, show them the pictures, get them involved in the excitement, and then we really need to get the public and politicians on our side. And hopefully things could change. And sort of in the words of Ambrose Bierce, is let's not abandon this year to a period of 365 disappointments. Right, thank you very much.
Thank you very much, Bruce. It was definitely food for thought. We've got a question here on the chat line. Neil, would you care to unmute yourself and ask your question, please?
Hi there, I can do that. Thank you very much, Bruce. Thank you for the presentation. I appreciate it. I've got a question about this indexing that you use. I'm always concerned when people index as far as back to the days of Moses, because everything will look great. And I'm thinking now, when I speak to clients of my own, they also, I can also try and make a good sales pitch and index back to 1980, and then everything is going up. As opposed to, then I'm asked, how do you go back to a reasonable index? Because we don't have a 50-year view. We want to make money in the now. So we end up going with various other indices. I mean, we index back to 15 years, for example. But I'm just trying to understand that when you change your index year, I mean, what would you say in practice would be a good period to go back for? Is it commodity specific? What do you do? Do you just do it generally, or do you do it based on the ask of the client? Thank you.
Okay. Yeah, Neil, I mean, I guess my question is, by looking at historical data, what are you trying to achieve?
Looking at historical data, I'm trying to sell something. I'm trying to say that this is blue sky country, this is elephant country, and we're going to win here. But at the same time, that 1980s to present covers 5-8 different types of mining regimes, different legislation at different times. So you're not really comparing apples with apples, I mean, or you are saying that the market will behave well, irrespective of what the mining legislation is of the day. The market doesn't care what the legislation is. The numbers just trend upwards and upwards with some days a correction here and a correction there. And because the legislation in the 80s and the legislation now and the legislation, whether it's the 91 Act even, is so different. So am I saying to them that this is the gift that's going to keep on giving, irrespective of the regulatory framework? Or can I map? Do I say, listen, can you see that the legislation changed at this point? It changed at that point. It changed at that point. This is where we had, So I'm trying to make a sales pitch. I am, but at the same time, I also want to be reasonable in my projections. I don't want to tell them that this is the gift that will keep on giving.
Yeah. Okay. I think, all right. So my point here was very, very broadly was to take the all share index, which I think, kind of what you say, that embraced all the different sectors. If you wanted to break that down, you could go break down and say, well, what was the mining contribution? What was industrial, financial, property, etc. But leave that aside. My point here initially was just to say is, here's the South African all share index, whatever the different components were, and in rands, we could have done it in dollars, and in dollars or rands, here's the US market. Just to say to ourselves that we matched them until August 2014. Then that gives you reason to say, well, how did we manage to do that? How come we were top 10 JSE? And all you guys listening in will understand the mineral wealth here was insane. It was absolutely insane. The gold, the PGMs, the iron ore, the manganese, the chrome, diamonds, it's just mind-boggling. The point is that the legislation and the tax regimes were good enough to attract skills and capital in here that we could build a country. A country and an economy that in terms of using the JSE as an index, we matched the US. So that's all I'm doing there. I take your point when you're trying to use, if you want to say, did this go up all the time? Well, you can't just look at nominal numbers. You need to go and deflate those numbers into real terms and then see whether they made money. And then if you're looking at the South African market, you need to see if that real return actually was worth the risk. Yeah, and it's not to say, okay, so why do we think, why have markets always gone up? Is because businessmen, if you pick the top 30 business people in a country and you just go and invest with them, even in the difficult times with difficult policy and good markets, bad markets, the top 30 will by and large circumvent, and they'll find ways of making money. And those companies do well. You know, there's a lot that you don't want to be invested that don't make it. And that's the challenge, is picking the winners. So the corporate capitalist system that we live and work in allows business entrepreneurs to navigate through policy, through whatever interest rates do, whatever labor legislation there is, and whatever global markets are doing. And, you know, for 100 years, South Africans produced incredible entrepreneurs. Brilliant, absolutely brilliant. And the question is, if can we sell that same story going forward? Well, we need to keep those entrepreneurs here, and politicians need to put decent policy on the table. So, you know, using indexes, you've got to be really careful as to what, you know, what you're learning from them.
Thank you. We've got a question then from Mary. Would you like to unmute yourself and ask your question, please?
My question is going back to a zero rating for the mining industry. If mining wants to be an economic activity, should it not also adhere to the fiscal regime that are imposed on other activities? Because essentially, if a project is not going to be profitable to be mined at fiscal regimes that other projects are feasible, it actually means that it's not economically viable. Because when you look at mining multipliers, particularly in terms of jobs, they are not that huge a number. And unless I believe that if your mining project that you are looking at is particular for creating material to be used internally in the country for some sort of strategic reason, there is actually no viable reason to give a zero rating to an economic activity.
Okay, so no, I mean, you know, broadly that you're absolutely correct, is because once you do things like that, you potentially are going to get a misallocation of capital. So money would go where it, in a normal situation, wouldn't go. So what I'm saying is that we are not living now in a normal situation. So when I look at the economy and I say, and I would ask you, which sector can best create jobs and create a multiply effect? Which sector would you pick? How are we going to create jobs here? Mary?
I think agriculture and manufacturing, yes, but not necessarily mining in terms of removing the actual material from the ground. Because from your economic analysis, you should be able to see that it's actually not viable and go with something a lot more viable. I think South Africa itself has such diversified economies that you should be able to find, because essentially any job should have some sort of downward multiplier effector. It's not just a mining job that has those multipliers.
Okay, but you know, at least mining, you've got the product. The product is sitting in the ground. It's there already. You don't have to go and manufacture it. So why have we got such massive unemployment? If we could just open manufacturing businesses, why are corporates and investors not opening manufacturing businesses?
Maybe is the problem also not because there is an over-reliance on these commodities, which tend to be cyclical in terms of revenue and in terms of jobs. So instead of advocating for a reliance on these commodities where we're not sure about what would happen in the next, well, 5 minutes, if anything goes wrong, would look at you know, more robust and more non-cyclical investment attitudes? It's just a question, really.
No, sure, but you know, my question is, I can't see, all I see is manufacturing closing down. I mean, if you listen to ArcelorMittal, the old Escor Steel presentation Friday a week ago, these guys are teetering. We have no construction. Construction has collapsed. How they are going to keep Vanderbijlpark going is to ask everyone to take a salary cut, maybe reduced work shifts, work different shifts, maybe night shift, day shift, to help save. They are trying their best not to close. They've closed Saldanha, they've closed a third of Newcastle, and it's not impossible that the whole of Mittal could collapse. Now, have you any idea what that's going to do to the Vanderbijlpark area? So I'm not seeing the manufacturing businesses being created. Where's the consumer? You see, a manufacturer needs a consumer. So where are our consumers?
Folks, I'm going to just hop in there at the moment. I'd like to continue this discussion offline. We've got a couple of other questions that have come up. Gary, would you like to unmute yourself and ask your question, please?
Look, I just wanted to pass just a comment on the tax issue that's just been discussed now. I think a zero tax is a very simplistic way of looking at it. It's to get a point across. If you go back into the 70s and 80s, South African mining tax was very complicated simply because it was designed to help weaker mines to grow, and the mines like Kloof, which in '67 was sunk and started producing and produced massive amounts of gold, were taxed a lot more heavily, so that we could actually have some cross-subsidization within the mining industry managed by government today. And I think it's that sort of thinking, I don't know, maybe I'm just guessing at it, but that we should be looking at. It's a lot more complicated than saying this guy's not going to pay and that guy is, but we can leave it till later.
No, Gary, absolutely. I mean, you know, I can tell you that at the height of profitability, Kloof Driefontein were paying with lease and gold mining formula, and there was ad hoc surcharge put on. They were paying just over 80% tax rates.
Yeah.
And you know, 10 years later, some of the mines were benefiting from the state aid formula. So there was that. Now, you know, my point with this is, instead of people flooding into the cities where they just cannot be absorbed in a city jobs are very different. Let's try it out. Let's go to the Northern Cape and isolate like a tax-free zone. Just let's play a game. Let's see what happens. You know, obviously you can't do it as a blanket agreement right across the whole industry. But anyway, that was, I'm just looking at ways of how do we create jobs quickly.
There's another question, Bruce, one which is very close to my heart. From Michael, your opinion on how politicians might be influenced more effectively than currently happening?
Yeah, with difficulty. But you know, the harsh reality is, and again, I think, as I said at the start, COVID has laid bare the inequalities all around the world. I mean, America have got huge inequality problems that they're going to have to address. But you know, everyone literally has got to make these politicians accountable. And we need to think long and hard how we resurrect ourselves. So if you can come with an idea on manufacturing, investor going to like that idea? Do we have the labor? Do we have the consumer to buy the product? You know, we're lacking in a lot of those things. But it's no good us relying on politicians to lead our lives anymore. We need to change and make our own destiny. And I honestly think that mining, I mean, that's what made this country. Why? Because the stuff is in the ground. Agriculture is slightly more difficult. It's not in the ground. We need to put it in the ground, grow it, look after it, find the water. So, you know, I don't mind which sector we pick, but, you know, in terms of getting the message to the politicians is it does not help us to sit and complain to each other. I mean, how many of us have actually gone and made an effort to find a politician and had a discussion with him? And I think that alone is going to start putting pressure on them. I mean, SAMCODES, do we get together and go to Parliament and ring the bell?
The short answer there is I've been trying desperately over the last year to get an appointment with the powers that be. But currently, everybody is far too busy with the COVID story.
No, sure. But I just think we need to really, really push the boundaries in terms of getting to politicians regarding policy and certainty in all aspects of our lives.
Absolutely. Bruce, thank you ever so much. It was wonderful getting a different aspect on the reasons why we deal with the codes and why we write competent persons reports. If you can stop sharing your screen, please. At the top, there's a red button that says stop sharing. There we go. Ken, would you like to share your screen while I introduce you, please? Okay, our next speaker
Thanks, Tanya. I'll do that.
Our next speaker is Ken Lomberg. Ken has some 35 years experience in the minerals industry, mostly platinum and gold. He's been involved in exploration and mine geology and has had the privilege of assisting in bringing a mine into full production. His expertise is especially in project management, mineral reserve and resource estimation. Ken has undertaken mineral resource and reserve estimations and reviews for platinum, gold, copper, uranium, and fluoride projects. He has assisted with the reviews or estimation of diamond and coal projects and assisted or compiled competent persons reports, NI 43-101 technical reports for various projects that have been listed on the TSX, JSE, and AIM stock exchanges. Ken is director of Pivot Mining Consultants, a renowned local mining consultancy. He is also the chairman of the SAMREC committee, which is responsible for the SAMREC code. He's also chairperson of CRISCO, which assists with managing the international mineral reporting codes, including JORC, NI 43-101, and various others. So Ken is well poised to talk to us for the next almost 2 hours about the SAMCODES and SAMREC in particular.
Thanks, Tanya. Can you see my screen?
Yes, we can, Ken, and we can see you, so all is well.
Perfect. Okay. Good morning, everybody. Welcome to this session. Let me just get my system to work. Okay, so I've been introduced, and thank you for that introduction, Tanya. I'm going to go straight into it. The codes can be considered to be a real put you to sleep type story. So the idea with this session now is that that doesn't happen. So although Tanya said wait for questions at the end, I'd appreciate if there are any questions or queries, give me a shout during the, as we go along, because it's probable that if I've lost you, I might have lost other people. And I certainly don't want to be in the situation where it's like this HIPAA, that this is a big yawn for the next little while. So please feel free to contribute. It will also help me to make sure that we are on track. So the intention of the course is supposed to be a basic course. It's not supposed to be advanced, and it's there for geologists and mine engineers. Sorry about that noise, it's on its way out. It's there to help you to be a competent person. So you can put competent person in your job description. So it's important that we understand that one of the things I'm not going to do is talk about estimations. So we're going to go through the code just about clause for clause, and that's why it could be a little bit soporific, but it's important that it isn't. The important thing is that we highlight what's there, and that it brings it to your understanding. And we're going to be basing all of this on SAMREC 2016, the latest version of the code. That's the front cover of SAMREC 2016. I'm sure that all of you have read it or read parts of it. So what we're going to do today is look at a bit of the historical background, put ourselves a bit in context with the rest of the world. We're briefly going to look at competent persons, although there's a session next week on competent persons in its entirety. And most of we're going to look at is part 4, which is the SAMREC way of doing things. Table 1 we'll also deal with in detail next week. So this is a statement of the CRISCO website, which I think is important, and in Bruce's presentation he highlighted some of the issues. Mining industry is a vital contributor to global and national economies. Never more so than at present, with soaring demand for commodities that produces, remembering that all raw materials are either mined or grown. There's truly an international business that depends on the trust and confidence of investors and other stakeholders for its financial and operational well-being. We discussed a bit of that with Bruce. Unlike many other industries, it is based on depleting mineral assets, the knowledge of which is imperfect prior to the commencement of the extraction. It's therefore essential that the industry communicates the risks associated with the investment effectively and transparently in order to earn the level of trust necessary to underpin its activities. So important takeouts here are that this is a depleting mineral asset, and we know the least about it at the beginning and hopefully the most about it at the end. So we're asking people to make the most important decisions when the risks are the highest. So if that's the life cycle of a mining asset, starts by being in the discovery phase. We go through a bankable feasibility study, then it gets you have operational, and then at the end you have closure. And our activity is here on the where we're looking at trying to develop a project and bring it into production or to maintain its production. Just like the CRISCO requirement or CRISCO important mandate is to promote international best practice in the reporting of mineral exploration results, mineral resources, and mineral reserves. And possibly a moment to pause is that we're looking at exploration results, the reporting thereof, mineral resources, and mineral reserves. So it's quite a broad field, and we'll get into each of that detail as we go along. Importantly, the codes sit in the middle of a whole lot of other aspects. So we see the international reporting codes. It's about good governance. It's about technical excellence. Hopefully that's where we are. It's about public reporting, which is interacting with the financial community in particular. Financial reporting, making sure that everything is understood by the financial community. Most importantly is, looking at the background to it, and this is looking back many, many years, there were a number of activities or incidents in the second half of the 20th century that got us to where we are. Probably one of the first was the 1960s, the Poseidon nickel boom and bust. It's a project in South Australia where there was reported to be nickel, and slowly but surely the reporting got more and more aggressive, and eventually it was discovered that they were not completely honest and there was virtually nothing there. So that was one of the first financial disasters. Followed, that resulted in the forming of what has become JORC, so the Australasian Joint Ore Reserves Committee in 1971, and that produced the first form of what is now the mineral resource and reserve reporting codes in 1989. So that was quite a while ago. That was also loosely based on some work that had been done in the 1930s in the US, and that was incorporated in the SEC, the SEC Industry Guide 7, which up until very recently has been the guide for the New York Stock Exchange. But probably the biggest one was the Bre-X affair in 1997. And very similar to the Poseidon and nickel boom and bust, the situation was in Indonesia, gold was found and it was pumped up to be more than it was. But also, I'm going to go into a bit more detail about that in the next few slides. There was Enron in the United States. Also important was the way in which information was presented to the public. So those were the things that brought us to the codes. So looking at Bre-X, it was a junior company in Calgary. The asset was Busang, was a gold deposit in Indonesia that David Walsh, so the picture on the right-hand side, he got involved in, and slowly but surely they drilled it, and you'll see that 1995 they had 30 million ounces, 1996 they had 39, July 96 they had 47 million ounces, and February 97 they had 71 million ounces. And there were rumors that they could have even more. So they were pumping this thing up big time. But a due diligence was done and only small amounts of gold were found. So that was 1997. One of the seminal situations is the geologist, de Groesman, is reported that he climbed on a helicopter in one place and didn't get off on the other. And the reports are that he either jumped or was pushed, or there's one that he might have faked his death and he's living in the Bahamas celebrating all his wealth. But be that as it may, importantly, the shares dropped, and they dropped significantly from $152 Canadian dollars down to almost nothing, $2.50 per share. Obviously, that's because the investors panicked, and lots and lots of people lost their money. And unfortunately, well, this is the statement that came out. Here it is in the fourth last line. However, the magnitude of tampering with core samples that we believe has occurred and resulted in falsification of assay values at Busang is of a scale and over a period of time in which precision that, to our knowledge, and without precedent in the history of mining throughout the world. So they say that an economic gold deposit has been identified. It's unlikely to be. So this was what was discovered. But there was almost no punishment for the people involved. Walsh and McNulty resigned. Walsh died of a brain aneurysm not soon after. Of course, the Groesman was nowhere to be found. And slowly but surely, the court cases kept on going, and eventually the only person left was the accountant, and he couldn't be held responsible, so it all fizzled out. However, the thing that did happen was it did develop what we now have as the international reporting codes. Probably the best way to describe CRISCO is the umbrella body over 14 mineral codes. So there's a list of 14 codes. The last one that joined was India in last year. Each of these codes is almost identical. And the important aspect there is that although there are differences between different countries, that there's a huge amount of commonality. And the sort of things that are different, Southern Africa, one of the things that we have is diamonds, and the diamonds is we have a guideline to diamonds that is world-renowned because we have developed it accordingly. For instance, the Europeans, the PERC, the Pan-European Reporting Code, one of their aspects is that they have a strong emphasis on aggregates and stone, because that's something that they have. They no longer have the big mines that we have. Most of those are mined out. So each national body has its own flavor. So these are the reporting codes, and because CRISCO exists, we are able to talk with our compatriots in the other countries and make sure that we are aligned and that the way in which things are done is very similar in all of these jurisdictions. Importantly, in the vast majority of these, there's a strong link between the code and the local stock exchange, which is important because, as Bruce was discussing earlier, the link with the financial environment is really important. So that's the map of the countries that are involved. It would appear that Russia's huge, but it's just the way in the projection. The formation of the codes started long ago. As I mentioned earlier, in 1971, JORC was formed after the Poseidon nickel debacle. Their first code was produced in 1989. Institute of Mining Metallurgy produced a first code in 1991. SAMREC was formed soon afterwards in 1992, and the SME, which is the American version, was they published their code in 1992. Then the first initiative for CRISCO was formed in 1994, and another seminal event was 1997 when the Denver Accord was held, obviously in Denver, about the same time or just after the BRIEX scandal. Importantly, that's where the basis for the codes came through. And one of the aspects that I'm going to discuss are the 15 core definitions, and most of those were agreed, at least in principle, at that point. Soon after that, in 1999, there was a agreement with the UNFC, and that has made sure that the CRISCO codes, or there's CRISCO representatives on the UNFC, so that the UNFC, although they've got a different way of doing things, there's some, we are represented there. So the first SAMREC code was presented in 2000. The first code for Canada was produced in 2001. SAMVAL formed soon after that, and CRISCO formed in its form now also in 2002. In 2007, the first update of SAMREC was published, and it was republished 2 years later with a few updates, mostly grammatical and small changes, and various other parts of the organizations were formed. So the SSC, the SAMCODES Standards Committee, was formed, and so was SAMOG, which is the South African Minerals for Oil and Gas. And they published their first code in 2015. And then we published the latest version of the SAMCODES in 2016, alongside a new version of the SAMVAL code. Okay, so important, the landscape that we operate in is more of a jigsaw puzzle than anything else. This slide is trying to show the aspects that are come together in with the SAMREC code. So the SAMREC code's here in the middle, SAMOG and SAMVAL, so they're interrelated. These are in yellow are the bodies that support the SAM codes and to which people need to be members or registered with. Resource and reserves are where we're going to. These are the legal aspects, the MPRDA, the DMR, and royalty bill. So these are aspects that are regarded as from a governmental perspective. And then we have competent persons and competent evaluators. So as I said, a bit of a jigsaw, and hopefully by the end of this course, you will have got a better understanding of how these things fit together. So the SAMREC code, let's look at the pertinent aspects. First one that we put on the table is it's a minimum standard. And that might sound a bit onerous, particularly if you've written a CPR, to think that this is a minimum standard and not industry guide. It's important that that really is the minimum standard and that we should be looking to do better than what's in the code. It's also relevant to all solid minerals. So therefore we exclude oil and gas, and that's why we have SAMOG, for instance, oil, gas, and water. I'll re-emphasize that a bit later. The one aspect there that might be an area of that needs addressing are brines. So brines, it's a bit of a gray area because obviously there's a solid component and there's a liquid component, but those are being addressed to make sure that there's some sort of understanding there or way to report. The codes are there to help investors, potential investors, and advisors, and to satisfy regulatory requirements. And that requires the guidance of CPs, competent persons. Importantly, the three big issues or the three big principles that underlie the code: materiality, transparency, and competency, and we'll go into those in a bit of detail in a moment or two. So what the codes are not. It's not a set of prescriptive rules. It would be impossible, given the jurisdiction of commodities, mineral size, location, all of those things, to have a prescriptive set of rules. There are, however, guidelines. As I mentioned, there's one for diamonds. There are also other guidelines produced by other jurisdictions, the Canadians, for instance. So those are very useful. It's also not a stick to punish a competent person. It's there to assist a competent person, and Table 1 in particular has been put in place to do just that, so that we provide some sort of guidance that somebody can go through and make sure that they've covered all the aspects they need to, and that that they can face their peers. Another aspect I'll mention numerous times. So the vast jurisdiction is something I've discussed. Underpinning it is also the data integrity, and what goes with that is scientific and engineering capabilities. So the code is a minimum standard, and I apologize for keep mentioning things. It's important that we emphasize these things regularly for the reporting, the public reporting of exploration results, mineral resources, and mineral reserves. As I said before, it's all about the solid mineralization, and it's also about the economics of deposits. It does not apply to oil, gas, or water, and it's about public reports. So it's things that go out to the public. However, having said that, many people would try and say, oh, just give me a CPR. It's never going to go public. That should be an alarm to you. It's almost certainly going to go public at some stage, and so best to make sure that whatever, if you've written a CPR, that conforms with whatever code that you've presented it to conform to. So the importance of public reporting is about corporate governance. It's an application of good practice, and it's making sure that there's somebody held responsible. And you see this little man on the right-hand side wanting to know who is responsible. Because when things go wrong, we've got to find somebody responsible. And although that can be pretty daunting, it's important that competent persons have taken responsibility for the work that they've done based on the information that they have. So, looking at the codes, and in the code, you will see that there are different colored blocks. They're yellow, gray, and then the uncolored blocks. So the yellow are the 15 definitions. The uncolored are what we call code, and the gray is what is called guidance. So we'll go through most of these things. Important one to start with is that this is about public reporting. So it's about informing people outside, particularly investors and their advisors, about the exploration results, mineral resource and mineral reserves. And it includes annual reports, quarterly reports, press releases, information memoranda, technical papers, website postings, public presentations, and often, and the other one is prospectus, prospecti, I suppose the correct plural of that. So when a company is listing, the prospectus will have the information about the resources and reserves. So it is consists of all forms of media, printed, electronic, including social media. And it's important that companies are providing information that is as comprehensive as possible in their public reports. And one of the ones that I'll mention again later on is it's not fair to the public to say, I've got a gold deposit with 1 million ounces, when that 1 million ounces is a kilometer below surface and is only at 1 gram a ton. So we encourage people to, when they publish stuff in the public domain, to make sure that they include aspects of tonnage and grade and any other activities or aspects that might well be important for an investor to know. The code itself, these are the chapters of the code. So it starts with a glossary, there's a foreword and some introduction, there's a section about competence and responsibility, a section about terminology, there's about general reporting, which we've mentioned very briefly now. Then you get into the 3 big areas: exploration results, mineral resources, and mineral reserves, the reporting thereof. Some background in technical studies, and then we have specifics on the reporting of coal, reporting of diamonds, the reporting of industrial minerals, and of metal equivalents. And the aspects of coal and diamonds, Tanya and Leslie will be presenting a bit later today, so I won't go into those in too much detail. We also have provided a checklist, table 1, which is really a useful way of making sure that an estimation has been done and incorporated all aspects that an investor would expect. And importantly, that's there not, as I said, as a stick to beat competent persons, but to help competent persons make sure that they are able to face their peers. There's also guidance about technical studies, a suggested table of contents, a suggested author certificates, and some guidance on compliance statements for competent persons. Okay, so I've mentioned this before. The gold aspects, or the gold highlighted areas, are definitions. There are 15 of them, and they are absolutely the same between all the 14 reporting codes that belong to CRISCO. Then we have code, and then we have guidance. And guidance is there to thresh out some of the aspects so that the competent person can understand what is there. So these are the 3 aspects of and the principles that underlie the code: materiality, transparency, and competency. And these come from the code itself. So a public report must contain all relevant information, this is about materiality, that professional advisors would reasonably require and expect to find for the purpose of making reasoned and balanced judgment. A public report is the responsibility of the qualified and experienced persons who are subject to enforceable professional code of ethics. and the reader of the report must be provided with sufficient information, and the presentation of which is clear and unambiguous to understand and to report, and is not misleading. So materiality must have all the relevant information, must enable somebody to have a reasonable and balanced judgment, must be providing information. It has huge impact on the public perception and value of the deposit, and that forms often the basis for valuation. And it must disclose all the material facts. It would be unfair to tell an investor that this gold deposit of 1 million ounces is a kilometer below ground, or this coal deposit is in a wetland that cannot be mined. Transparency, issues that are important, there must be sufficient information, must be unambiguous, not misleading, must be clear, balanced, and importantly, we mustn't be silent on any issue. Sometimes an investor would like not to highlight a negative aspect. Unfortunately, we've got to be strong enough to say that's not acceptable and that we need to present that information. Competency, that's where we come in, and that's what hopefully this course will help you to do. I'm not going to try and make you qualified. I'm going to try and give you some guidance. So suitable qualification in the mining industry, obviously geologists, mining engineers, surveyors, and a few others. Suitable experience, and we'll go into that a bit later. 5 years minimum experience. Professional membership. So importantly, that we belong to an organization or registered with an organization which has an enforceable code of ethics. That if we do something incorrect, that we can be held to account. And being held to account, it's not necessarily being barred from working. It may be as simple as rewriting a report or correcting an aspect thereof. And importantly, we mustn't be unduly influenced by whoever commissioning the work. That can be very difficult, as many consultants will tell you. The client has decided that they want a particular outcome, and they'll do anything to make sure they try and get it. So importantly, the overriding aspect here is a competent person must be satisfied in their own minds that they are able to face their peers and demonstrate competency. So whatever we do, if somebody should ask us, we should be able to say, I've done this for this reason or that reason, and I believe it's the way it should be done. I've made these assumptions, and this is the estimation that I've made. So what is the benefit of using SAMREC? First of all, it promotes best practice. There's a common language and common concepts, which means that investors are able to talk about different projects and put them on the same sort of level. It makes it imperative for them, for transactions, for looking at projects and mines. It helps non-technical people understand what we're talking about. Resources and reserves are the basis of valuations. We've also provided guidance to competent persons. The interesting one is that we're self-regulated. And this is one we'll talk about when we talk about competent persons. We don't have to write an exam, although people in Canada have to write a form of an exam. However, we're going to be held accountable, and we should be providing some sort of risk mitigation to somebody who's investing. And importantly, SAMREC is also relevant to South Africa and Southern Africa. So just like this little boy, he's gone to his mother and said, "Can you have a snack?" And she doesn't want to get up off the couch. So she says, "Sure, help yourself." And he's very chuffed with that. So he's out to the kitchen, and he's got the cookie jar. But his mother wants to know why he's not eating an apple or an orange. And he's very upset because for him, a snack meant something, and for her, a snack meant something else. And that's why we want to have the code's important, is that we speak the same language. And also that it's relevant, that we're not trying to put a square peg into a round hole. Importantly, the code is the code, public reporting, the competent person are all related, and through the code, that relationship is very strong. So what is the public reporting meant to be? It's meant to be signed off by a competent person. It must be based on reasonable assumptions that are clearly explained. It must be consistent with the standardized terms and definitions. So that's why we have the code. So we have those definitions that are standardized. Before the codes came into existence, mineral resource and mineral reserve was ambiguous between different people who are saying the same thing. It needs to be unbiased and identify potential risks and uncertainties. The reporting must be balanced and not misleading, so it must tell the whole truth, and it must be in a format that will allow comparison of projects, and it's understandable to reliably or reasonably informed investors. What it's not, the reporting against the code is not a guarantee of good work. So even though it might have this 120 or 150 page document, it doesn't necessarily mean it's good work. It's not a cookbook on how a resource estimate or a mineral reserve estimation is done. And having a CPR doesn't necessarily mean, or having a mineral resource or reserve does not mean that the project is good. Investors still has to make that decision themselves. So by reporting according to the code, one can't be putting lipstick on a pig. So, SAMCODES Standards Committee. Okay, the committee is there to provide standards and recommendations for the guidelines of mineral resources and mineral reserves and valuation for mineral assets in South Africa. So that's the body to whom I report in this country. So it's not only about resource and reserves, it's also about the valuations. And that's a type of structure. So here on the left-hand side, we have all the important players. In blue, we have the Geological Society and the Southern African Institute of Mining and Metallurgy. They are the patrons. They support the codes by providing facilities and finance for them. But associated with that, we have Engineering Council of South Africa, Institute of Mine Surveyors, the Southern African Geomatics Council, the South African Council for National Scientific Professions, the Council of Geoscience, SA Institute of Chartered Accountants, the DMR, Minerals Council, Investment Analysts, Bruce is our representative there, the JSE, General Council of the Bar, the Geostatistical Association, the Law Society, and the South African Oil and Gas Agency. So all of those provide input, and there are three codes: the SAMREC code, the SAMVAL code, SAMOG code. So those come underneath that, and we have SAMESG, which is a guideline a very useful guideline that forms part of the organization. And as I said before, the patrons, thankfully, Geological Society and the Southern African Institute of Mining and Metallurgy support us. Otherwise, this work wouldn't be able to go on. For the rest, everyone is a volunteer, so no one is paid for this work. So the SSC has representatives, and Tanya is the current chairperson thereof, and then we meet at least twice a year, but we meet quarterly, and we discuss all the aspects of all of the codes to make sure that the codes remain relevant. The JSE is also an important aspect. The JSE, as I mentioned, is one of the other organizations that assist, and the JSE has a readers panel for solid minerals, also one for oil and gas, which reviews all documentation related to transactions that pertain to JSE listed companies, to publicly listed companies. Having said that, one has to remember that SAMREC is not only about publicly listed companies, it's also privately listed companies. Many private companies have used SAMREC because it gives the investor an understanding of the what is in the ground, and so that they can be able to market their project or their mine and get significant investment. There's also a complaints procedure through the SSC. So the important one is that that where people err, it's important that they can be held to account. The SSC does an initial investigation before passing on the complaint to whichever body the person belongs to. And we will discuss those in a moment or two. So, and I'm not going to go into this in too much detail, but the JSE requires that all companies and the minerals board use the SAMREC and SAMVAL, and all of that is highlighted in what's called section 12. So this is what it looks like. And the JSE does require that a competent person's report is approved by the readers panel, but the approval is there about compliance. It's not about a project. So even if a project or a report is read by the readers panel and approved, that doesn't mean necessarily that they say this is a good project. It's only that it's compliant. As I said, it must be compliant to SAMREC and SAMVAL, must be less than 6 months old in date, and it can be published on their website in its entirety, or sometimes they put abbreviated forms. The competent person should not be dependent upon the issuer or should disclose the nature of the relationship. So one of the things about SAMREC, the competent person doesn't have to be independent of the company. In many cases, the company would be using one of their employees to do the work, and that's not a fatal flaw. Employees are allowed to be competent persons, but they then have to disclose the relationship with the commissioning entity, which would then be their employer. The competent person's report must have a valuation section, which will be dealt with in this course a bit later. It must be published in full on the website, and also the executive summary should be published, but I'm not going to do too much detail about that. The readers panel is employed by the JSE. There are, I think, about 16 people on that panel. Each one has their own speciality, and they are mandated by the SSC. Okay, so we're going to look at this figure one quite a few times. So I'm going to take a moment or two to explain how it works. So we've got exploration results, mineral resources, and mineral reserves. So, and we've got down this axis here, increasing geoscientific knowledge and confidence. And along this axis, along the x-axis, the consideration of modifying factors. So mining, metallurgical, infrastructural, economic, marketing, legal, environmental, social, and governmental factors. In resources, we go from the lowest confidence of inferred to indicated to measured. And this is reporting in situ, and we're going to discuss what's called a reference point a bit later. On mineral reserve side, we have probable and proved. The Canadians use proven. It's one of the ways that you can trip somebody up. Many times people use the word proven instead of proved. And this is reported as mineable. And we can see the relationship between resource and reserve. So only indicated and measured can become reserves. And indicated can only become a probable reserve. However, measured can become either probable or proved mineral reserve. Another aspect that here I should mention is the Australians use the word ore reserves, and we've in our code have said that the ore reserve and mineral reserve are equivalent, although we prefer people to use mineral reserves. Another aspect I mentioned much earlier was this is a type of risk assessment, which is something we should be able to present to a investor. Exploration results are very high risk. As we go in resources down from inferred to measured, we're reducing our risk. So we're knowing more about what the deposit. And if we go from resource to reserve, we're reducing our risk even further because we've now put on the important financial aspects, the viability aspects. So exploration results, mineral resources, as I said, in situ, increasing geoscientific knowledge, inferred, indicated, and measured, reserves, dependent upon the modifying factors, probable and proved, and making sure that we have that relationship between indicated and probable, measured, and proved or probable. Commodities that we're looking at. So we're looking at, remember I said, all solid minerals. So we're looking at bulk commodities, coal, bauxite, iron ore, manganese, base metals, lead, zinc, nickel, and copper, precious metals, PGMs, gold and silver, precious stones, diamonds, emeralds, and others, mineral sands, rutile and zircon, energy, coal and uranium, but not oil or gas, rare earths, and industrial minerals, and there are a whole host of those. And the idea is that the reporting can be done under any one of these different, for any one of these different commodities. And that's one of the reasons why the code is a form of guidance and not prescriptive, because there would be no way that we could write real beneficial prescriptive rules on all these commodities in every geological setting that they would come in and in every jurisdiction that they would be found in. Here are the 15 core definitions. We've looked at public reports briefly. We've got the competent person, exploration target, exploration results, mineral resource, indicated resource, inferred resource, mineral resource, measured resource. We've got the modifying factors which convert resource to reserve. We've got mineral reserve, probable reserve, and proved reserve. And supporting that, we've got what's meant by a scoping study, a pre-feasibility study, and a feasibility study. So this is, I've explained this one for general minerals. We've got one for coal. So coal resources and coal reserves, as opposed to mineral resources and mineral reserves. Here we have, it's important, the reference point is going to is mineable in situ estimates for resources, and for reserves is run of mine and saleable estimates. So I know Leslie will go into that in a bit more detail later today. Diamonds, very similar. Also, diamond resources and diamond reserves. So the in situ and then what is mineable. Okay. At this point, I would say, is everyone following? But I assume everyone is. Otherwise, I would be hearing somebody say something. Increasing level of geological, geoscientific knowledge. So it's not only geological, it's all scientific knowledge. So it would be things about recoveries and all sorts of things like that, which should also be important. So the tons and grade would be reported depending upon the level of geoscientific confidence, the different degrees of technical and economic evaluation. And possibly one of the things I have failed to mention at this stage is resources and reserves. One of the big differences, or one of some of the important underlying aspects, a resource must be able to say that it has reasonable prospects of eventual economic extraction. So one has to be able to demonstrate that there's technical ability to exploit whatever the mineral is. So if it's on surface, it can be mined, and that means that possible technically, and sometimes there are going to be environmental or government aspects. Having a mine that's potentially inside a nature reserve is unlikely to be something that will fly. So then it's not reasonable. But the word eventual is there because sometimes it might not be entirely reasonable at the moment because the prices are low for instance, for a platinum mine now, the platinum price is lower than it's been for a very long time. But for a gold mine, that might be no issue at all with the price at over $2,000 an ounce today. But a reserve requires that not only is the technical aspect demonstrated, and it's demonstrated to a level of a pre-feasibility study or life of mine study, but the economic aspect is as of the date of reporting. So it's not giving any leeway to say that this could happen in the future. This is saying based on the current prices, current technology, current operational and capital expenditure that can be declared. So that's a big difference between resource and reserve. And anything that has no eventual prospect of being mined should then be considered, would be probably considered as country inventory, and that would wait for another day. So the important aspect of the code is there to get this gap between, to make sure that this is all of economic value. If it's not of economic value or with no potential of economic value, it should not be reported underneath the codes. Anyway, getting back to the degrees of confidence. So there are, in the bottom right there, I've got a note that says, this usually reduces to quite a short list of resource critical geoscientific elements such as volume, density, and sampling, chemical analysis, QA/QC. So it's important, for instance, one of my hobby horses is density. If density measurements are not for bulk in situ dry density, good chances you're going to have completely unrealistic expectations about how much of the metal is in the ground. So that's important that that's done to a very high level of confidence. Exploration results, and this is fairly complicated. Exploration results are generated by exploration programs. They can be used by an investor, but they are not part of a mineral resource or mineral reserve. And that's because there's not enough information and you haven't demonstrated the economic aspects. But an exploration result can include a target, and there are two ways of doing that. So if an investor has or a prospecting right owner has a piece, has access to a piece of ground where they think that there's gold, and they're hoping, based on what they know, to demonstrate there's a gold deposit of 1 million or 2 million ounces, they can have a strategic look at it and say that's an exploration target. So that's what I'm trying to achieve. One of the important aspects here is when we report that according to the code, is that both the grade and the tonnage are given in ranges. And also it's important that it's not misconstrued as a resource. So it doesn't have the same level of scientific and engineering work to support it. However, it may, in some cases, there may be some work that's been done on a project, and it's a bit more than just a thumb suck. That somebody has demonstrated that there's a reasonable chance that that there is something in the ground, and then they would also report an exploration target based on the work that they've done. Once again, that would be on a range of tons and grade. So it's not a formal part of a mineral resource declaration, and it must not be presented in a way that unreasonably implies the discovery of potential economic mineralization. So it's still up in the air, and it needs to report both positive and negative. And often minerals exploration results are reported as intersections as a drilling campaign is undertaken. And the important part here is that it should be both the good ones and the bad ones. It's unfair, or it's not right to let investors believe that you've only got positive results when they're negative results. Then we're likely to get into a Break situation once again. However, having said all of that, it's important that there is some actual physical evidence that can demonstrate that there's continuity of mineralization on the property. So it could be geophysics, it could be geochemistry, it could be trenching, it could be some wildcat holes. but there needs to be some physical evidence. It must be where there's historical information, and that's many times the case. It must be considered by the competent person that it is relevant, and they must state their conclusions. One important thing, aspect here is the competent person is calling their is using their competence and calling on their own competence, saying, I'm competent to do this. It's my considered opinion on that, and it's important that that opinion is that the reporting thereof is balanced and is not selective. Selective reporting is really unacceptable. So exploration target is a statement or estimate of the exploration potential of a mineral deposit in a defined geological setting, where the statement or estimate is quoted as a range of tons and grade. It's a concept of mineralization with respect to the type, quantity, or quality, depending upon whether you report percentage of the mineral or ppm, which would be of interest to an exploration or mining company. There must be a likelihood that the exploration target occurs in an area of geological prospectivity for that commodity and mineralization type. The exploration target need not represent it in discovered mineralization, nor does it imply reasonable or realistic prospects for possible economic extraction. Important aspect here are ranges are what's important to report. Exploration targets, they need to describe the rationale. Without concrete exploration work of a specific mineral property held by the company, public reporting of the exploration target must be regarded as solely speculative. That's why we say not a good idea. Mineralization must not be expressed or misinterpreted as an estimate of the mineral resource and mineral reserve. However, it must be in a detailed explanation as to what's there, must be close to the statement in the report. So explanation on the basis of the statement and proximate statement with the same provenance. So it's not right that exploration result or an exploration target is presented and the footnotes are in font size 2 that you need a magnifying glass to look at. They must be in the same font size as the rest of the document. So what do we call something before we've got it, before it's been demonstrated to be economic? We call it mineralization with a capital M. So it's a material of potential or possible economic interest in the Earth's crust, or in which quantity and quality cannot be estimated with sufficient confidence to be defined as a mineral resource. So this is what we call pre-resource. So the data and information relating to it must be enough to allow considered and balanced judgment on its significance. So there must be something to suggest that it's there, but nothing has been demonstrated. We call that mineralization. So we get into the first of the important aspects of the big name, so to speak, mineral resource. So mineral resource is a concentration or occurrence of material of economic interest in or on the Earth's crust in such a form, quality, or quantity that there are reasonable and realistic prospects for eventual economic extraction. Location, quantity, grade, continuity, and other geological characteristics of the mineral resource are known, estimated or interpreted from specific geological evidence and knowledge, including sampling. What that means to us is that we must have confidence in the location, the shape, the tonnage, the density, the physical characteristics, the grade, and the mineral content of the deposit. And there are no confidence limits on a mineral resource. So we don't say it's 20% or 5%. It's all to do with the competent person's judgment. Okay, so it's an occurrence of possible economic interest. It does we do have to, if it does not have reasonable and realistic prospects of eventual economic extraction, it should not be or it cannot be a mineral resource. And here we're talking about in situ mineralization. So whatever's in the ground. At this stage, we're not looking at what comes out. That's when we talk about mineral reserves. And we must have enough understanding of it based on whatever exploration strategy we've got, whatever assessment we've made, and sampling. And we would then be declaring a resource. And if we would apply modifying factors, then we would be declaring a reserve after we've declared a resource.
Sorry, Ken, can I ask a question?
Please do.
Confidence limits, sort of at the CRISCO level, have those been discussed, relative to resource reporting and what's the outcome of those discussions? I know where you've ended up, but maybe if you could just give some background to how we've ended up without, the decision on not using confidence limits.
Okay. So thanks, Rodney. The important aspect is that there are no percentages that would say this is inferred, or this is measured, or this is indicated mineral resource. It's never been a discussion as to what those should be, as far as I know, at a CRISCO level. And the reason is because it's got to be based on the judgment of the competent person. And there's some people that would use, different people use different ways to classify. Some people use things like kriging efficiency or a slope of regression to do that. Some people use a scorecard approach. And there are all sorts of ways, different ways of doing it. But there isn't a way to say a percentage. And for me, the real difficulty is to say a percentage of what. So where do you get your confidence percentage from? So there's not, so Rodney, unfortunately, there's not an easy answer. To my knowledge, it's never been discussed or not in my time at CRISCO, it's been discussed. It's led entirely to the judgment of the competent person.
Ken, before you carry on, there are a couple of other questions that have come up in the chat line. Would you take a couple now?
Sure, no problem, Tanya.
Okay. We have one from Jason, who asks, can a company elect to publish an abbreviated form of the CPR? Does the valuation section specifically published in its entirety on the JSE website?
Okay, so Jason, there's no such thing as a short form report in CRISCO. So we believe that the principles of materiality and transparency, all information should be presented in a competent person's report. And that's the reason why we don't believe that short form reports should be, that they're right at all. The ones that we've seen people produce, they are a bit of a whitewash. So hence the reason that we don't believe that the right thing to do. Many cases, the prospectus presents only the salient facts that a investor would like the public to know, and that's why a full declaration is important. As far as valuations are concerned, as far as I know, the valuation, the full valuation and the full CPR should be available on the company's website.
And then we have another one, which, as you know, is very close to my heart. Are unlisted companies exempted from complying with the SAMREC code?
The SAMREC code, if somebody declares a resource or reserve in terms of the SAMREC code, then they must apply the full might of the SAMREC code. If they don't call it a SAMREC compliant resource or reserve, then it's not SAMREC compliant or we're not expecting it to be. The private company, in my view, if they should be using the code, because then they already elevate themselves to a similar level to a public company, and that gives them a whole lot more credibility. If they don't declare it according to the code, in my view, they're letting themselves, they could be doing better, and they're not publishing giving the deposit the right publicity.
And then there's one last one, which you might want to take now or work into your presentation later. It's a view about inferred resources in a mine plan or a reserve. What percentage of inferred resource in a mine plan would you be uncomfortable with?
Okay, let's wait. Let's leave that on for a bit later. If I don't answer it in sufficient detail, let's come back to it at that later stage. Okay.
Thank you. That's all we have here.
Right, let's soldier on. Okay, so a mineral resource must have reasonable and realistic prospects for eventual economic extraction based on the technical economic factors. And as I've said before, it's important that we're not bound by the moment, so we can look at prices and technology, although in the future. Importantly, that can't be infinite. So we can't say in 50 years' time, we believe that the technology will be good enough to extract gold from water, from seawater, and be economic. We've got to be reasonable about it. And so the technology's got to be reasonable, and the economic aspects have to be reasonable to be considered a resource. The important aspects are things like the cut-off grade, yields, or recoveries, depending upon what you're looking at, and minimum thicknesses. That's, for instance, for what it would be a stratiform deposit like the Wits or the Bushveld, it would be unrealistic to believe that you can mine something that's 20 centimeters thick. It would, unless you can demonstrate really well that it's in there. An important aspect on this picture is that we've got a coal seam on the right-hand side, and often we talk about quality. We talk about quantity or quality, and here this is where the coal seams would be where we talk about quality. So we'd be looking at things like CVs or ash, or whether it's an anthracite or a coking coal or whatever. So quality sometimes an important aspect to consider, and it would be similar to a concentration in some cases. Okay, so eventual, I've discussed this a little bit, but for some commodities like bulk commodities, where the footprint of the deposit is much bigger, to be a longer period of maybe as much as 50 years. For other deposits, it would be much shorter, but importantly, it's also, it can't be too far away, because then it's then we don't meet the reasonable prospects test. So ultimately, it comes down to the competent person, which aspects they consider would fall in the reasonable aspects of eventual. It does relax the standards, but it doesn't take them away completely. Okay, so mineral resource. Mineral resource may include mineralization below a selected cutoff to ensure that the mineral resource consists of bodies of mineralization of adequate size and continuity to properly consider the most appropriate approach to mining, including any dilution or contamination resulting from the requirements of any minimum mining width. So it's important to consider various aspects of the deposit when the reporting is done. So geological and grade continuity are important, and we're going to discuss those in a moment or two. An inferred resource, which is the lowest category of resource, The grade or quality, so that's for coal would be an example, are estimated on the basis of limited geological evidence and sampling. Geological evidence is sufficient to imply but not verify geological and grade or quality control. So you don't, so an important one is here, inferred geological continuity or grade continuity. This is a case that would be an aspect, this is an iron ore deposit somewhere in Africa, if I remember correctly. All the boreholes, as you can see, are drilled on top of little hills. Now, the continuity becomes an issue, and so that you would wonder, can a resource be declared for all of these areas? And each borehole would effectively then be reporting on its own area. So one would have to consider whether that's correct or not. So an inferred resource, we've said limited measurements and sampling. An important thing is, aspect here, it cannot be converted to a mineral reserve and must not be stated as part of a mineral reserve. And in the little picture on the right-hand side, you've got the red, which is measured, green, which is indicated, and the blue, which is inferred. So it's further away from the current mining generally, so there's less information. The Canadians they've added sort of interesting aspects to it, and so they would say an inferred mineral resource is acceptable for mine design and planning. But still full disclosure is required. And when I say mine design and planning, that's very preliminary stuff. We'll go and look at some other ideas, some other aspects as we go along with the other aspects of mineral resource. Indicated mineral resource, it's important here that we're going to have geological and grade continuity. So it's no good saying I've got, I can see the deposit at this point and that point, but you must also be able to say that the grade is, there's some sort of continuity in grade. Or you've got to in some way explain why you would then have it as indicated mineral resource. So it's a higher confidence than an inferred resource, and it is sufficient confidence to allow the application of modifying factors in sufficient detail to support mine planning and evaluation of the economic viability of the deposit. Remembering at this point, once we've got an indicated resource, we can then consider having a reserve if we've applied a pre-feasibility study or life of mine plan. But it can only be converted to a probable mineral reserve. So the Canadians have added a little bit there, say, can be estimated to a level of confidence sufficient to allow appropriate application of technical and economic parameters to support mine planning and the evaluation of the economic viability of the deposit. And that's all important because that goes to declaring a mineral reserve. Measured resources even more requires more scientific confidence, geoscientific confidence, and application of modifying factors supported a detailed mine plan and final evaluation of the economic viability of the deposit and its geological and grade continuity. So we've got to be sure that we've got all our ducks in a row. The exploration has been done, and we have been able to apply the right technical and economic factors to say that this has got reasonable prospect of eventual economic extraction, and we're going to be happy that we can then consider doing a pre-feasibility study and converting it into a reserve. One of the things I failed to mention about inferred was there's got to be a prospect that can be converted to indicated. So it mustn't be just pie in the sky. So once again, looking at the Canadians, they're saying can be estimated with confidence sufficient to allow the application of technical economic parameters to support production planning and evaluation of the economic viability of the deposit. So they looking for a little bit more ability to do more work with whatever is produced in the measured mineral resource. And the measured mineral resource can be converted to either proved or probable mineral reserve. So mineral reporting of mineral resources. So typically we'll have a table which will have the mineral resource in it with measured, indicated, and inferred. And an important aspect is that they shouldn't just be added together. So we don't just add indicated and measured together. We actually report them individually. And we don't report content only. So saying that the measured resource has a content of 2 million tons of copper at 1.5% would be the correct way to say it. It wouldn't be right to say that there are 300,000 tons of copper in that deposit. So we've got to make sure that we have sufficient detail that somebody understands. And the important part of having a grade there as well is because that talks to whether it can be recovered. As I said earlier, the application of the right modifying factors will get us to reserve only of indicated and measured resources. And the last point on this slide is that this is an estimate. So whatever is we are presenting is an estimate. And that important aspect there is that it should, although a calculation is undertaken to get there, it needs to be understood that there's a level of uncertainty associated even with a measured resource. This is a graphic trying to explain to somebody about the difference between inferred, indicated, and measured. So, and importantly, this is to decide where it falls is the skill, it's skill judgment of a competent person, and needs to take into account all the items in table 1 in order to rate what the confidence is. Okay, moving on to modifying factors. So now we are moving away from the resource. We're looking towards reserve, and there are a number of important modifying factors. Obviously, mining method, processing, the type of processing, metallurgical, infrastructure, making sure that there are things like power and water, and if there aren't, that there's cost included to do it. The economic aspects that would include not only price, but also would include capital and operating costs. The legal aspects, do you have the right to it? Are there any restrictions? Environmental and social possible restrictions or aspects that have to be considered, and governmental factors, which would include things like getting licenses and opening up new areas and working in areas which would previously not have been worked in, like nature reserves and the like. So there are the 9 modifying factors. Looking at each one, important to consider. And these cover very broad aspects. So once again, they're not prescriptive. And in most cases, in order to declare reserve, we're going to need a team of experts. So we would have a mining engineer, a metallurgist, an engineer, civil engineer, or civil, electrical, and mechanical engineers about the infrastructure. You would want somebody who has an economic background to help with deciding, doing financial models. You would probably need some sort of prediction of pricing. You would need to have an opinion about, you might need to have an opinion about the legal aspects. And Environmental would important. The consideration there is not only what activities are undertaken, but what the costs are of that. The costs are, for instance, of closure would be important to consider here. The social impacts would be important in this country. For instance, the social and labor plan is a very big part of getting a mining right, and that would have to be built into the feasibility of the operation, and that would include if there's going to be a clinic built or a hospital or a school or whatever it is. And governmental issues might well be constraints that are in place on the project over and above the economic aspects. So, important part of a mineral reserve, it must be economically mineable. Part of the measured and/or indicated mineral reserve, and includes diluting materials and allowances for losses, which may occur when the material is mined or extracted and is defined by studies at pre-feasibility or feasibility level, as appropriate, that include application of modifying factors. Such studies demonstrate at the time of reporting extraction could be reasonably justified. And when we talk about pre-feasibility studies, we also mean a life of mine studies. So an ongoing mine doesn't have to do a pre-feasibility study. They need to do a life of mine study at the same level of accuracy. And they must be able to demonstrate economic viability for now. Now, the reference point becomes important at this juncture. The reference point is when we talked about resources, we talked about in situ, so we know it's in the ground. However, when we come to reserves, it's important that we're looking at a reference point. Now, for instance, base metals and precious metals, often the grade is reported at the head. In other words, once it's mined before it goes to processing. However, many other commodities, like industrial metals or coal or some of the bulk commodities, important aspect there is considered is what is sold at the gate. So a coal deposit will take the coal and it will have different fractions that will be sold to different clients, and each one of those will then have different marketing aspects, and they would have different pricing. So then the reference point would be at that point. It would be at the gate, in other words, after processing. It's important that when we present a reserve, that we make sure that we've indicated what the reference point is. So the mineral resources can only be declared if there's a life of mine plan or pre-feasibility study. And let's go on to look at the two categories of mineral reserves. So we've got probable and proved. So the competent person should, you applying the modifying factors, but you're applying them to to indicated resources to get a probable reserve, or you're applying less confident modifying factors to a measured resource. So the competent person has got to take into consideration those aspects. Many people would put indicated straight to probable and measured straight to proved, but there are cases where if you don't have enough information about a particular modifying factor, you might not declare a proved reserve from a measured resource. As with resources, there are no rules for classification. The competent person needs to decide, and that's where experience comes in, and that's where the 5 years experience that the competent person is required to have is important. An aspect that needs to be understood is that whether the resource declared is inclusive or exclusive of the mineral reserve. So if you take the resource, which is in red, and you then take out the reserve, if you report the whole of the red, as a resource, and you report the reserve, and you say that then the resource is inclusive of the reserve. Then one of the aspects here that is worth noting is that reserve numbers and resource numbers should never be added together, because reserve numbers include losses and dilution, whereas resource numbers don't. So that's where this difficulty comes in. So you would have to decide whether that's included or excluded. So that's using the boundary of where the mining is to decide. And you might end up having a tabulation that looks like this. On the top, it's exclusive. On the bottom, it's inclusive. So you see here the resource is 4 million tons, whereas the top here is only 2. And you can see that the reserve is the same on the right-hand side, but material has been removed from this from the exclusive and only reported under reserve. If you took all of the indicated and made it all probable, then these numbers would all be 0, and you would only have an inferred resource. Technical studies are important because we use those as a basis for the declaration of the resource. So there are three types of studies. There's obviously a scoping study, a pre-feas, and a feasibility. So a scoping study, which is one of the definitions in the code, is an order of magnitude technical economic study of the potential viability of the resource, using realistically assumed modifying factors, together with any other relevant operational factors that are necessary to demonstrate that at the time of reporting, the progress to a pre-feasibility study can reasonably be justified. So at this stage, we're not declaring a reserve, we're only determining whether there's some potential viability. And the code says that we must do, a competent person declaring a resource must do an assessment to determine whether the resource has got realistic prospects of eventual economic extraction. And so a scoping study would possibly form that sort of study, but is not a requirement. So a pre-feasibility study is a comprehensive study of the range of options for technical economic viability of a mineral project. So at this stage, we're looking at whether the mine's going to be what type of underground mining, whether it's board and pillar or conventional mechanized, or if it's an open cast, what size of open cast it would be. That has advanced to a stage where a preferred mining method in the case of underground mining or pit configuration in the case of open pit is established and an efficient method of mineral processing is determined. So some options have been thrown around and considered, and there's some idea of which is best, and a financial analysis based on reasonable assumptions on the modifying factors and evaluations of all other relevant factors which are sufficient for the competent person acting reasonably to determine if all or part of the mineral resource can be converted to a mineral reserve at the time of reporting. So the different options are considered to the same level, and then a decision is made on which option to go ahead with. So, and the important aspect here are the level of work that's undertaken, which we'll get into in a moment. So a feasibility study is a comprehensive technical economic study of a selected development option for a mining project. So where pre-feas would have said this is going to be an underground mine with board and pillar, then the feasibility study would go one step further to demonstrate that this is actually going to happen. So there's a bit more detail in the actual work done. So it's a detailed assessment of applicable mining factors together with any other relevant operational factors and detailed financial analysis that are necessary to determine at the time of reporting that extraction is reasonably justified and economically mineable. Results of the study may reasonably serve as the basis for a final decision by a proponent or financial institution to proceed with or finance the development of the project. So those aspects are important, but for what we're considering is we have to demonstrate viability for now based on that. And to help, we've included in the code, we've included a table 2, looking at the differences between the different studies. And so here we've got some difference about what type of resources included, whereas scoping would quite probably include mostly inferred, where feasibility you'd want to have measured and indicated, and the outcomes would be mostly probable for a pre-feas and proved and probable for a feasibility study. And looking at, for instance, the mining method, you move from being conceptual to being detailed and optimized. And then the risk is moved from high to low. And unfortunately, one of the things that often occurs is people, when they want to know about a study, all I want to know is about the level of cost, percentage of cost. But for instance, here we would be looking at, I'll get into that in the next section, but engineering, amount of engineering work, a scoping study is a lot less than a pre-feas or a feasibility study. So less than 5% for a scoping study and up to 50% of a feasibility study, remembering that there's probably going to be a lot of detailed drawing and other design that goes in afterwards. That's important. Probably one of the things that's important, I think it's on the next slide. Yeah, so the accuracy ranges of the costs. Scoping study up to 50%, whereas a feasibility study between 5 and 10%. And sometimes the important one there is to consider that scoping study, most of the costs are factored, whereas a feasibility study, you've got costs that you've got actual quotes for, and in a pre-feas, you've got actual quotes for significant aspects that will underpin the study. So here, okay, so unit costs, that's what I was talking about now, based on historic data or factoring, whereas the pre-feas, you're looking at the labor, the actual estimates of important components. There'll be some factoring, whereas feasibility study, you want detailed estimates of everything. And you would then be looking, and as you see, this is entitled OPEX. So you would consider OPEX and CAPEX possibly in a separate form, and there's different levels of contingency applied to both. Importantly, this is one of the things that is very useful to demonstrate to an investor. The green is the value, and the red is the risk. The idea is that the work that we've done to get to a reserve, we've brought this risk down, and we've brought the value up. So the green is the value, and the red is the risk. And that's the level of engineering required at each point. And you can see how that's improved the value, and that's reduced the risk. This is a diagram that you'll see, particularly the valuation. And this is important that the work that we've done in resource and reserve declaration is used for valuations. And I'll come back to the question about inferred. With the proved and probable situation at discounted cash flow, even from indicated discounted cash flow, and a market comparison can be used. When we're doing marketing comparisons, it's when we write down at the bottom, and when we're using exploration expenditure as a value method, it would also be down at inferred or indicated. The question was asked about how much inferred should be used in a mine plan. The general consensus is that there's no percentage that would be right, but there's sometimes when if you don't include inferred, then you probably don't have a mine. But it's important to be able to demonstrate profitability with and without the inferred aspects. So if it's uneconomic without the inferred, then there's got to be a question about whether it's a reserve or not. Industrial minerals, we've spoken briefly about them. Important is that one needs to be have some knowledge of these aspects, and that requires particular expertise. But we've put in a whole section at the end of the code about industrial minerals, and the important the aspect here that I'd like to highlight is must have a defined specification. So, for instance, aggregates have not only size but shape requirements, so it needs to be considered. Also, deleterious minerals. If there are aspects that won't work, for instance, dimension stone, cracks and fractures, they can be no-goes. So it's important that these are considered. Importantly, this is all about what can be sold. So saleable product is important, but there may be a situation where the same quarry, for instance, can produce a number of different products, and they would all be then need to be declared. Metal equivalents. This is a situation where, for instance, you have a copper and cobalt operation, and you report an equivalent copper concentration, makes it easier to talk to investors. Then you need to have applied all the principles of transparency and materiality. And for mineral equivalents, the important aspects that you need to have the grade, the recovery, and the price, so that you can do the proper calculation, and you need to show the calculation when you do it. This is something that isn't actually very often done very often, but we provided for it. There's a table of contents that is loosely based on the 43-101, which is a very good way, the Canadian format, which is a very useful way of presenting a report. None of the stuff in this part of the document is mandatory, it's all guidance. So it's up to you how you want to apply it. But if you use table 1, many of the questions will be answered by using the table of contents. So the certificate of the competent person, it's important that we as competent persons sign off. And one of the ways to do it is to include a certificate at the end of the report. There are many examples. Here is an outline of one, so that at the end of it, you've added your signature to the document, and they can find who did the work. And there are two aspects there. You might think that this is just in order to find a way to punish people. No, this is also a way of helping an investor. If your credibility as a competent person will help them sell their product, their project, or get funding for their project. So this is what it looks like. I'm not going to go through it. It's at the back of the code. I think I've got to the end of the formal presentation. Perhaps if there are any questions.
Okay, thanks very much for that, Ken. But we still have a couple of questions here on the chat line. Nadira, did Ken answer your question about the percentage of inferred resources in a mine plan?
Yes, thank you very much. He did.
Okay.
It's Martha here. I also have a question with regards to reasonable prospects.
Please go ahead.
I'm sure, I mean, many companies have some sort of guideline, because the guidelines are specific to whatever they do, whatever they produce in relation to reasonable prospects. But there's always that extra explanation that one has to provide when you're saying we need to determine what the inputs are, so that you can determine your RPEE at the end of the day. And there's always that tug of war, but you being stringent, but you being that. And yes, you know, for an open pit mine, it's quite easier because you can just apply Q and then factor that. But for underground operations, how does one actually get to that point of saying, okay, these are the guidelines that I've applied, considering the modifying factors, but obviously applying them to a lesser extent than you would, or stringency than you would with your reserves.
Okay, so Martha, thanks for that question. Perhaps one of the things I didn't highlight is that we must distinguish between a company's anticipation of a hurdle rate in getting over a certain hurdle rate to consider that this project is worth investing in, and determining that it's viable. One can determine that a project is viable and they can make R1. It's still viable. Obviously, all assumptions will have to be interrogated, but you could have a situation where it's viable for R1, but it's not a situation where the company would want to invest because there's not sufficient profit coming out of it. So we need to distinguish between those. So the guidelines that you're looking at will maybe be what a company is looking at to be able to demonstrate that this project will really work. And that's slightly different from what we would want, what we would have to say that it's viable. It's also, it's one of those things that is reason that competent persons need to have the right experience, is because then they've learned what the guidelines are, and the guidelines are for specific commodity. But having said that, many times the way to find what those guidelines are is to go and look at projects that already exist or have been documented. There are some on the JSE website, and the other place to look is on SEDAR, SEDAR.com, which is the Canadian website for all of the listed companies. And they're often very good examples of financial models and ways of approaching things that can be used that will be helpful.
Okay, Ken, can a private company
just add there to that question? You know, the industry a lot of the time is, you know, reporting resources within a whittle shell for an open pit, and on an underground scenario now using a stope optimizer. So, you know, obviously the gold price used on the resource being higher than the reserve, and if it falls within a stope optimizer, declaring that as resource, as opposed to just, you know, inventory underground. So the question.
Absolutely correct, Rodney. It's important that sufficient technical work has been done to demonstrate that it can be done technically, and to incorporate that in a financial model.
Neil, will you go ahead and unmute yourself, please?
Thank you very much. I just want to ask, who is the owner of a CPR? So if it is written for the public, whichever the public is defined as, who is the owner? So can a company, for example, conceal a CPR? Can they withhold it, or whatever the case may be? So I'm trying to find out if we can't have a single, much like you mentioned CEDA, but isn't there a mechanism that all CPRs get lodged in a single place so that we don't redo work? So ultimately the question is, who owns a CPR? And I'll listen.
Okay, thanks, Neil. So I have a similar feeling. It would be fantastic if all CPRs were, certainly for public companies, were publicly available. Unfortunately, one needs an organization to handle that, and we don't have that in this country. The CPR would be the property of the company. So the company would decide how they want to publish it. So in the code, we look and say the ultimate declaration, the way in which the declaration is made, is the responsibility of the company directors. However, the work that is done still remains the responsibility of the competent person. So if the directors decide to publish part or all of a CPR or only the nice parts, that's I wouldn't say they have liberty to do that, but they may well do that. But they then take responsibility for that. And so that's why often we say that where publication is made, the competent person needs to give the written permission that it's in the right context, that the bad parts haven't been removed to make it look squeaky clean when it's actually black as soot.
Okay, can I just add to that? You see, in our company, we pay an auditor. So the company, this company where I sit, we pay an auditor to prepare our tax documents that goes to SARS. And so we can see what has gone to SARS, and of course the auditors can't, they can do what they do, but they don't exactly conceal our tax affairs from SARS, who is the consumer of the information. Now, similarly with CPRs, I'm trying to understand who is the consumer of the information. If the public is the SARS in that discussion, then clearly the companies can't actually be the first reader of. They can't receive. They can get a copy of it, yes, but shouldn't they then not be able to decide or have any influence over what happens to a CPR? Because I understand, just like they paid for the CPR, I paid my auditor as well. But I can't tell my auditor to lie. I mean, I can, I'll go to jail. But similarly, I pay for it, but I don't own it. So I'm thinking that CPRs probably need a discussion of who owns them, and it shouldn't be the company, and it shouldn't be the directors, is what I posit in this. Thank you very much.
I think, Neil, you make a very valuable point. One of the things that is very tough is that we've put into the code a statement that the competent person mustn't be unduly influenced by the company, but invariably there's the CPR is shared with the company, and they also they're normally responsible for putting it into the public domain. The person who's doing it doesn't necessarily know which legal avenue or where it's got to go, and who must receive it to put it in the public domain. So I suspect it's slightly different to the tax example that you used, but I think that there are some valuable points that probably haven't been discussed enough.
Any more questions?
Yes, I've got a question here.
Okay, go ahead, Jason.
Hi, Ken. Could you go over the relationship between CIM 2012 and the National Institute 43101? It follows on from Neil's comments as well. From the guideline to the prescribed reporting framework. Do we have something similar in South Africa?
Okay, Jason, no. One of the reasons why things are a bit different between us and Canada is that a 43101 is a legal requirement. So where the 43101 is effectively what we'd call a CPR. So that's the where everything is declared. The standard to which the CPR is written are the Canadian Institute of Mining, the SIM standards. So SIM standards are equivalent to SAMREC, and the 43101 is the equivalent of a CPR. So that would be the relationship they have, and they have their code. The SIM standards are therefore are slightly different because they are more aligned to the legal system than SAMREC is in this country. The SAMREC doesn't have legal standing except through the JSE, where public reporting of public listed companies is required.
Thanks, Ken.
Any further questions? Going once, going twice, sold. Ken, thank you very much for your presentation. And we look forward to you coming back tomorrow and talking to us further about Table 1 and competent person themselves.
Talking about
We've now
next
got a
week, I
couple of
trust.
minutes.
You said tomorrow, you mean next week?
Yes, I mean next week.
Keep her honest, Ken.
Okay, folks, we've now got a 15-minute tea break. You're welcome to stay and ask questions, or you can just pop out. Try not to leave the Zoom room. Go out and get your cup of tea, bake your muffin quickly, and then we'll come back to start again at 11:30 sharp. Frida, if you wouldn't mind putting your camera off, please. We also have a couple of folks who still have not renamed themselves. If you don't rename yourself with your name and your surname in whichever direction, we can't give you a certificate of attendance. So please make sure that we've got your correct name.
Can I ask a question?
Yes, certainly, Senzani.
I think maybe I had stepped out a bit, but I needed to find out the clarification of how much of inferred resources that you can include in your mine planning. You know, like a guideline. Is there like a guideline, like a certain percentage that you can work around?
Unfortunately, there isn't. What I did say is that it's important that, well, the requirement is that there may be a requirement that inferred is required to demonstrate in a mine plan to demonstrate a life of mine or for various other reasons. But the reserve must be able to stand by itself. So declaration of reserve, one can show the value of the company with inferred and without. But the mineral reserve must be able to stand up by itself without the inferred.
Okay, I understand that, because where I'm coming from is that, you know, like during your mine planning, like accessing, you know, your indicated or measured resource, you find that, you know, at times you have to go through some inferred material, and you can't, you know, can't do away with that. So I thought that maybe, you know, there's a limit that you might have, because, you know, it's some of those things that you can't exclude.
Absolutely. They're going to be, you're absolutely right, there are going to be situations where you're going to have to mine through inferred to get to measured or indicated for whatever reason. But you need to, you'd have to demonstrate that you can mine that from the feasibility aspect, the inferred doesn't add any value to that. But it's one of those things that when the situation arises and you don't know what to do, is to talk to someone who might canvass other people to see how they might have done it. It's very difficult to have a general response, but there's definitely not a percentage of inferred that would be allowable in a life of mine plan.
Oh, okay, all right. Thank you so much.
Hello, Ken, Thomas here. Can I come in that subject?
Go for it, Thomas.
Isn't this where you have to go through the inferred? Isn't it where the competent person will now have to make their own judgment and decide to redeclare it, not as inferred, but as something else, maybe indicated or measured? Because how will you know you will need to go through that if you're not confident about it?
Absolutely, Thomas. But there are situations where you would, there are definitely going to be situations where you would have to mine through an inferred block to get to an indicated block. So just because you're mining through it doesn't mean that you can upgrade it to indicated. you need to make sure that you're using the same parameters as your declaration elsewhere in the deposit. So it's not often, but it does happen.
Okay.
Anybody else? While we still got a couple of minutes, Nolene, do you want to put up the second poll, please?
I absolutely do. During one of our previous sessions, I got into such trouble putting the Eastern and the Western Cape together. I'm glad to see Gordon's not here today.
You have to put in the Republic of Hout Bay then too.
But also there's nobody from the Eastern and the Western Cape, yeah. But surely, Tanya, that falls under other. Hout Bay, I mean.
Yes.
I interrupted somebody who was going to say something.
Apologies, I interrupted you. Yeah, there is one representative, but I'm logging in from KZN this morning while I'm based up here now.
Oh, tricky question. Where are you really from?
Yeah, well, I'm from the beautiful Western Cape, living and working up in KZN at the moment and loving it here.
Well, the weather's definitely better in winter.
Definitely. So while I have the mic, I might as well shoot. Good morning, Ken. I just have a quick question, and I think I logged it on the chat. I just wanted to know, does a client have any legal standing to request a CPR document annually from you? Where I'm coming from, we supply one of the largest SOEs in the country with one of our products, obviously, to use in their beneficiation. So obviously we are not giving them a document. We're not putting the document out for any investment. So do we have to supply them with a CPR annually?
Andy, there's no legal requirement to report for SAMREC in any form. So there would be if there was a contractual obligation that might exist, but from a legal perspective, there is none. And in most cases, unless you've done significant amount of work in a year, there's no justification to re-estimate your resource or your reserve. In most cases, it would be depletion only. So I would fail to understand. I don't think there's any legal way that they can go after you unless you've got it in some sort of contractual format.
All right, thank you very much. I think you pretty much answered, or yeah, just verified exactly what I wanted to hear. And that is basically it. So the mine or the operation hasn't changed significantly in a year. And, therefore there is no need to do an update to the mineral reserves regularly. There's been no additional drilling, none of the sorts. There would only be survey depletion. So there's no need for us to give them a 160-page document. So yeah.
No, just be careful there, Andy. There are a few things that you've got to be quite careful of. That remember that a resource or reserve is dated. So if you date it for 2019 and in 2020 we get COVID, there may be aspects of your resource or your reserve that are no longer valid. So it may no longer be compliant because of what's happening now. And also as prices change, that might also make things very different. I have a situation currently where a client last reported a PGE resource in 2008, I think. Then platinum was nearly twice the price of palladium. 10 years later, it's reversed. So just because you can do it from one year to the next doesn't mean you can do it from the third year to the first year. So regular updates are probably smart, but it just make sure that you don't trip over yourself, that you missed out on something along the way.
All right, copy that. Thank you very much.
Pleasure.
Sorry, Andy, Gary Chapman here. I was just wondering, they're not using it as an annual business plan instead of doing their own business planning.
I'm not too sure.
Yeah, to me, that's what that sounds like, is that somebody somewhere has got this, or we got a consultant here, he's doing this job, and it's, look, we've got a big report, so we've got a good plan.
Mm-hmm.
And yes, there would be depletions, as Ken was saying, but that would then also change your indicated and measured. As you minded, you'd be depleting those, but you should be, But to me, a business plan would suffice for what they're doing. Thanks.
All right. Thank you.
Okay, well, hopefully everybody's got their coffee and their muffin and everything else. And we should possibly get on to the rest of it. So we're going to end the poll.
We are Tanya and have.
Okay.
Okay. And I'm going to stop sharing the results. Right. So, Tanya, do you just want to jump right in?
Just bear with me 1 second.
Sure. Did you forget your muffin, Tanya?
No, just sorting out some issues in the kitchen. Okay, so as Ken said earlier, SAMREC has a diamond-specific reporting section, both in the main code and also as a separate guideline. Well, why? Well, if we have a look at diamond deposits, they're extremely low grade and highly variable. Look at this diagram here. Diamond deposits are some of the lowest grade deposits that we look at. And particularly in respect of alluvial diamonds, extremely high heterogeneity. The term quality that we use in mineral resource estimation is not the same thing as grade when we look at diamonds. And diamond deposits have extremely different depositional types and mineralization styles, and each requires specialist knowledge and estimation techniques. And with respect to the valuation or pricing of diamonds, well, the price of gold is the price of gold is the price of gold. However, every diamond does not have the same value as another one does. You all know the 4 C's. Well, they all combine in different ways to give each diamond its specific value. Diamond valuation is a very specialized field that falls outside the purview of most CPs. So in order to accommodate all of these issues, SAMREC has diamond-specific clauses within the code itself, as it has coal-specific requirements. But within the diamond-specific requirements, it also has a diamond guideline document, which expands on each of these clauses here and shows how they should be applied in the public reporting space. Ken has also touched on the fact that there is a diamond-specific figure 3, where we use diamond resources, diamond reserves, as opposed to mineral resources and mineral reserves. And over the last few years, we have also seen an increase in the number of listed gemstone deposits. These deposits have many similarities with diamond deposits, and the guidelines are applicable to these kinds of deposits in general terms. So we're going to start off and go and look through each of these to see what specific issues are needed in diamond reporting. And the first one is the exploration results. And in terms of the application to the broader principles, there's no difference to any other exploration program. And as Ken has discussed this morning, exploration data can be generated in both desktop studies and also in preliminary prospecting programs. Here's a list of some of the information and data that most exploration programs would generate. And there's no difference at all with what we would see in any diamond deposit. However, in a diamond deposit, there are some specific data and information that we would acquire, which you don't necessarily, or you don't find at all in other commodity types. The other thing about diamond exploration results is that you can use historical data and information. The important thing is here is if the CP considers it's reliable and relevant. Here we've got 2 examples. The first one, I can just highlight that particular feature here. Here we see a Fisher mine that has been mined out historically. This would be mined out in the last couple of years, and this is the measured, indicated, and inferred diamond resource. Now, whether or not you should be able to, or whether or not you can use this information would be dependent very much upon how relevant it is and how applicable it is to the other information. The second example that we have a look at is this one. If, for example, we were trying to estimate a resource on K2, if we had information from K1, we would certainly be able to apply or use the information required or acquired in the volcaniclastic material as well as the hypoabyssal material and make implications. Whether or not we would be able to use the dike material, even though it is hypoabyssal, another discussion in itself. But certainly if this was your deposit and you were trying to use historical information from here, well, how reliable would that be, since there's no definition as to what type of kimberlite that would be? The other kind of information that we often find useful is from adjacent or nearby properties. And again, we need to demonstrate relevance. So, for example, if we've got information from this mined out operation, we know grade, we know diamond value, we know mining costs. And if, for example, this is your next concession, how applicable would that information be? Would you be able to use this? If your concession was sitting out over there, would you be able to use information that you collected here and apply it there? I'm sure you'll agree with me that it is only if that was your concession and you were looking at this deposit, then it would make sense to look at information from here and not in either of these two projects. The third thing that we would look at is some physical evidence of assumed continuity. And simply because you've got a project which is adjacent to another one that's got a dike or a gravel run, that does not by itself provide justification of continuity. Here we have a real-life example out in the northwest, where there is a gravel deposit which has been mined for at least 60 or 70 years on these three properties owned by one company. The next company obtained the rights to the property to the south, and they used the grade and the value of the gravels there to provide a reason to go do some prospecting on the property to the south. Now, it just so happened that the fence boundary coincided with a chert ridge and also a quartz vein that actually cut out the gravel run. So unless you've got some physical evidence, something to show that that gravel should or is on the property, there's no ways you can use the information on that property, even if it is adjacent to it. Here are some examples of the types of exploration deposits that we would identify based on the exploration data and information that we have. This one is of a conceptual project where we would look at, in a desktop study, regional activity, the fact that we've got a kimberlite sitting up there, that we know people are mining on the river further down. We've got some estimation of diamond grades and values from these two different operations. We can identify the fact that we've got terraces, high-level terraces sitting up here. We've got river flats down there, a present river channel. We might be able to look at our geophysical data or remote sensing maps and get some estimation of the target areas and volumes, because we've got a few artisanal pits sitting out over here and also over there. And from this, we can generate conceptual targets that we would then go and do some exploration on. Then once we've highlighted our exploration target, we've actually gone in there and laid out a grid and done some prospecting. Maybe 2 or 3 of these holes we've actually expanded into bulk samples. We've got some information, but we don't have enough technical data or confidence in it to call it a resource. So it is very definitely diamond mineralization. Or on that same project, we may have done or completed all of our drilling, all of our sampling, and think we have a very good idea as to what is there, but we haven't demonstrated any reasonable prospects. Because if we look at our mining cost curves, say that one is the one that is applicable to our project, we know that if our diamonds are $150 a carat, then we're going to need just over 100 carats, 100 ton in order to make that payable. However, our grade is only sitting at 50. So in this particular example, we don't have any RPEEE. And so this remains mineralization. It cannot at this stage be upgraded into a resource. The next example on this I'd like to have a look at is here on kimberlite exploration. We've done some geophysics and we've identified a number of targets. And so for the first 2, we went and put a hole in and bingo, we found some kimberlite. And we may even have taken some microdiamonds, done some analysis on it, and got an inclination that, yes, there might be diamonds in it. So this would be our mineralization. But outside of it, we've got something that we haven't drilled. We don't know if it's kimberlite. Looking at the anomaly, it looks like it could be. Another one there and this one over here. So these would be conceptual exploration targets, whereas this would be mineralization, our pre-resource mineralization. And as Ken highlighted this morning, mineralization is a subset of exploration target. It is not some low confidence inferred diamond resource. Moving on to kimberlitic indicator minerals. Indicator minerals are particularly important in respect of exploration, and they provide indirect evidence for the potential occurrence of diamonds in primary deposits. They're not applicable to alluvial or marine deposits. In fact, they're completely meaningless because secondary deposits can have contributions from more than one primary source. These secondary deposits also have been subjected to extensive post-depositional modification, such as calcritization or laterization, for example, both of which can destroy our indicator minerals. And even the physical travel distance can destroy other indicators, such as ilmenites. So when you are looking at kimberlitic indicator minerals, you cannot use them to infer grade or value for a diamond resource estimation. They're only used in exploration targets, and what you would do there is to say, well, this one is more interesting than the next one based upon the indicator minerals. And of course, it cannot be used to estimate a value for that project either. So in brief summary, We've then got our desktop studies where we generate our conceptual targets. This is what we would do. We'd review available data, look at regional information, satellite data, and generate target volumes. Under reconnaissance exploration to identify pre-resource mineralization, we'd actually go in and do some exploration. And both of them would be classified as exploration target with all the caveats that Ken mentioned earlier. And it's only once we got into the systematic work that we'll be able to estimate a diamond resource. This is the definition of a diamond resource. The first thing that's important is to identify reasonable prospects for eventual economic extraction. And again, nothing different from what Ken mentioned this morning. It would be a high-level assessment. We're not looking at a scoping study. You'd look at these features, your geological, your engineering, and your various other factors in order to determine whether there's a fatal flaw in any one of these factors. With respect to the term eventual, note that diamond deposits are reasonably short-term deposits. It's not the 60 or 70 years that you have for other bulk commodities, but rather typically less than 20 years, and even less so when you're looking at alluvial deposits. Looking at geological characteristics, there's two things I want to highlight here, is that we don't tell you how many holes or how many samples you have to take. It's determined by your site-specific geology. The other thing that's important is that if you've got a complex deposit, you often need to take more samples and do more drilling than you would on other commodity deposits. For example, here, this beach deposit. Now, it's obvious that the grades and diamond values associated with these beaches and wave-cut platforms are going to be very different to those found in the backwater lagoons. So you're going to have to sample each facies comprehensively and separately. You can't take one big bulk sample over here and average it over the entire deposit. Sampling. Volumes can't be estimated on remote sensing or geophysics alone. You've got to have some sort of corroborating drilling or pitting data. So if that's your geophysical anomaly, you've at least got to have some information on it before you can identify or estimate the volumes associated with it. Also, not able to estimate from adjacent properties, even if they are in full production. And you can't base your resource volume on historical estimates or artisanal results. And I'd like to just highlight that there's a nice paper coming out in a forthcoming SAIMM journal that deals with historical estimates and under what conditions they might be used in grade estimation. When looking at the diamond resource to classify them, the basis of classification is particularly important. In diamonds, we use the same standard classification categories: inferred, indicated, measured diamond resources. However, need to mention that few diamond deposits ever get to the measured resource. Because of the heterogeneity, the variability of grade and value, it's often not possible to get to that measured resource. And marine deposits, well, they sometimes don't even get as far as an indicated resource. I'm not saying that it's impossible to get to a measured resource in a diamond deposit, just noting that it's highly unlikely. So if you're reading a report that has measured resources, read it twice. And of course, that implication is the same for a probable and then a approved diamond reserve. Nothing different from how we classify and explain or justify which criteria we use in order to determine which classification it goes into. One of the important clauses that we highlight with respect to diamond estimation techniques is this one here, which says that if you use untested practices, you need to justify it. This is not an attempt to limit the use of technologies or to get new methodologies. Just be sure to explain and justify if it is not a mainstream method of estimation. The other thing about resource classification with respect to diamonds is that for each geological domain, we want to have a look at least preliminary indications of all of these features. Very often we have a kimberlite deposit. Initially we go in and maybe do 2 or 3 samples, say, okay, fine, we've got an inferred resource. But then next year we come back, do a systematic drilling program and decide, okay, well, this actually is not mineable. This is particularly important. We expect that the majority of inferred resources could be upgraded to indicated diamond resources with continued exploration. Just a word on size frequency distributions. Irrespective of what classification we use, we must provide a diamond size frequency distribution and a discussion of the relevant parcel size. And just as a bit of guidance, we suggest that you look at a minimum of 100 carats on a low confidence SFD. Now, obviously, if you've got one diamond that has 100 carats in size, this is not applicable. Here we've got 2 examples of size frequency distribution, and this is a grade size distribution. All 3 of these curves are from exactly the same deposit. The green one is when we have 100 carats. The blue one is when we've got 2,000 carats, and the red one is for over 30,000 carats. So you can see the dangers of interpretation when you have just got limited numbers of diamonds. Microdiamonds, again, are not applicable for secondary deposits, but many of the same reasons as the indicator minerals. One secondary deposit might have hundreds of primary sources. And also your alluvial processes may flush out your microdiamond population and only leave, for example, the +5 carat stones. And then what does a low microdiamond grade mean? The other thing to remember about microdiamonds is that while diamond grade can be estimated using the microdiamonds, to determine a diamond value, you need to have macrodiamonds. You can't estimate diamond value on microdiamonds. So in order to get a diamond resource, you can have microdiamonds, but you do also need a certain amount of macrodiamonds. And just on that, when you refer to the sieve sizes, please discuss what you're using, because often you might use Tyler mesh or square mesh when looking at grade estimation, but then when you do valuation, your results might come with the DTC or as grainers. So please make sure that you identify which system is used and also show a correlation or conversion where more than one system is used. Briefly then looking at what an inferred diamond resource is. Contrary to a mineral resource, we need geological grade and value continuity, even at an inferred level. And then we also have a small, or a parcel that is too small to be representative. We can't assay for diamonds. So when we look at grade estimation, we need to take bulk samples. And here are just some examples of how bulk samples are taken in the diamond industry. For an indicated diamond resource, again, we have geological grade and value continuity, and it's at indicated level that we actually give a recommendation for diamond parcel size. The indicated resource requires a fuller understanding of the information, and that's typically done through a bulk sampling or trial mining. Just a comment, difference between bulk sampling and trial mining. Pretty much no difference on a diamond deposit, except the scale. Generally, we use the term bulk sampling to refer to that stage of our project where we estimate resources all the way up to the indicated classification. And then trial mining, that's the pre-feasibility study that converts resources to reserves. Here we give some indication as to the size of diamond parcel that you should be looking at in order to get a representative diamond value. Whether you're looking at an inferred resource or an indicated resource. And this is the point I want to highlight. While this might be the guideline, under certain circumstances, you're going to need more stones in order to get a reasonable value. And probably one of the best examples I can think of is the Letseng diamond mine, where they've got over 5,000 carats, they still don't have a decent value or reasonable value. Important that the evaluation must be current, typically less than 6 months old. But of course, there are certain circumstances where you can use older valuations, combine that with SFDs to infer current value or prices. But irrespective of these circumstances and here, the CP must discuss the rationale and justify what they are doing. When it comes to the technical studies associated with the reserves, there's pretty much no difference between diamonds and any other deposits. There's also no difference between the standard of primary and secondary deposits. You might not have the same amount of studies or level of information on an alluvial deposit, but the same standard is required as that on a kimberlite deposit. Just very briefly, the pre-resource mineralization, you can't do a technical study on it and it cannot be converted to a diamond reserve. An inferred diamond resource can be subject to a scoping study, but you certainly can't convert that to a reserve. And our indicated diamond resource, either a pre-feas or a feasibility study, converts to a probable diamond reserve. When you write your diamond CPR, it's fundamental to incorporate the diamond guidelines into that CPR. It's not a separate report. You don't do a normal CPR plus a diamond report. These are integrated into a single report, as well as Table 1, Section 11. All of those which are diamond and gemstone specific requirements, again, they need to be incorporated into the general reporting sections. They're not a separate report or a separate chapter. And we also give a guide to the table of contents. It's not obligatory, you certainly don't have to follow it, but just like there is the guideline in SAMREC, we also have the same thing within the diamond guideline. Thank you. Okay, if there are any questions, I shall take some questions if there are any. Andy, yes?
Good morning, Tanya. I just have a quick question with regards to the experience of a CP when it comes to diamonds. As you pointed out, there are marine alluvials and then kimberlite deposits. So if you had, I say, 5 years or 4 years in alluvial mining, would you qualify to call yourself a CP when it comes to marine?
How much experience would you have in marine?
Well, if I'm talking about myself now, I've got 3 years in marine and I have 5 in alluvial. So, yeah.
The short answer is you don't have to have 5 years in fluvial deposits and another 5 years in marine deposits, because many of the principles would be the same. The bottom line is you would need to be able to stand up in front of your peers and say, I do understand this deposit, and therefore I qualify myself in order to write the CPR.
All right. Thank you. One more question. When it comes to a break in your, let's say, practicing with regards to a particular deposit. So at this point in my career, I've moved out of diamonds. I'm now in industrial minerals. But let's say I return to that game, if I can call it a game, in 5 years' time. Would my experience or my prior experience still qualify me as a CP?
Your prior experience would be particularly useful, but you really should bring yourself up to speed on what's been happening in the diamond industry in the intervening 5 years. You would need to demonstrate that you have kept up with your CPD requirements, or that you're up to date with the new exploration prospecting techniques that are happening at the current time. What the code does say is that we need to be competent in the thing that we're reporting. So yes, that previous experience does count, but you do need to bring yourself up to speed if you're going to act as a competent person going forward.
All right, then. Thank you very much.
Okay. Yes, Senzani, very quickly.
Yes, I have a question on being a CP for diamond reporting. Let's say you have worked in the diamond industry like for 5 years and moved off from the field, and then after 10 years, you need to get back into the industry and have been requested to sign off on some diamond reporting. Do I need to build up again from that, or can I just carry over from my previous experience? What does the code say about that?
The code doesn't say that our experience has to be continuous, but it does say that it has to be relevant. So if you're able to use your previous experience, you would also need to bring yourself up to speed with what is happening currently in the diamond industry.
Okay, thank you for that. Another question though is that, like when they're doing the drilling program, do I also need to be there as well? Like whilst they're doing some of their drilling campaigns, in order to be satisfied that indeed the drilling program is from that particular pipe. The reason I'm asking is that they already are mining in another specific diamond pipe, and they've recently discovered another pipe that's about 30 kilometers away from that, and they would want to report resources from that diamond pipe. Do I need to, to be able to be satisfied with their drilling, their results, be present whilst they're doing some of their micro diamond analysis?
The short answer is yes. You have to satisfy yourself about the information about which you are reporting. Make sure that you're comfortable with what they're drilling, what they're sampling, where it's being sampled. Trust me, don't just take anybody's word for it.
Yes, that's correct. Thank you very much, Tanya.
Great,
Okay.
thank you so much. If there are any other questions, could you type them into the chat, please? And Tanya will help you and take care of those afterwards. Leslie, do you want to share your screen with us, please? You're on mute. If you, sorry, you're on mute.
Bottom left-hand side of your screen, Leslie, there's
I've
a
unmuted
little
you.
microphone.
I've unmuted you. Right, and then if you just want to click on the bottoms, yeah, that's it.
Okay. I wasn't sure if you could see the screen or not.
We can.
Sorry, nothing's happening this end. There we go.
That's it. Great. Okay, if you'd like to go right ahead. Thanks, Leslie.
Good afternoon, everybody. For those of you that don't know me, my name is Leslie Jeffrey. I currently work for SRK Consulting here in Johannesburg and have worked in coal all my life and hopefully can stick it out for another few years before I retire and that the coal industry will last that long in this country. I'm going to kick right off. Coal is slightly different to some of your other minerals in that it has a special section in the SAMREC code like diamonds do, and coal followed a slightly different route in terms of reporting codes way back in the 1990s, so long before I got involved in this kind of stuff, where the industry requested that this was done through the SABS and that a South African national standard for coal reporting was developed. So this was done, but when SAMREC included coal, we linked the national standard into SAMREC. So we follow SAMREC. So public reporting must be done for coal, must be done according to the SAMREC code. So that's clauses 48 to 59. And we also include table 1. And we must consider SANS 10320, as we call it, and the latest version is this year's version, 2020, second edition, and clause 49 in the SAMREC code will tell you about that. Companies that are listed on more than one securities exchange often report according to both SAMREC and the relevant reporting code for other jurisdictions, for example, JORC or PERC. Coal reporting follows the three main CRISCO principles of materiality, transparency, and competency, and you will find that in SANS as well. Just a quick note, there's some slightly different terminology in coal reporting. For example, we don't talk about mineral or ore or mineralization. It's coal and coal deposit. Coal quality instead of grade or mineral content. And we talk about coal processing modifying factors rather than metallurgical modifying factors. And my pet bugbears, we don't have hanging or footwalls, we have roofs and floors. So just to tell you a little bit about the standard that came out earlier this year, the effective date is from the 1st of January 2021, but we encourage everybody to use the new version as much as possible before then. It's published by Standards South Africa, which is a division of SAB, South African Bureau of Standard, and it gives us the definitions, the standards, and the common terminology for public reporting according to the SAMREC code. It details the systematic evaluation of coal resources and coal reserves with regard to the reliability and the confidence of that evaluation, and it gives you methodologies that you need to consider when preparing your public reports. You need to use all of SANS. You can't just pick and choose. And especially the why, if not, why not principle applies. And the reason for this is if you haven't done it, explain why you haven't done it, because it tells the reader that you have actually thought about this and you give reasons why something does not apply in your particular case. If you don't mention it, you run the risk of people thinking that you actually don't know enough to think about things. And then I just want to draw your attention to this word shall in SANS. Many of us think that the word must means you have to do something, but actually in English, the word shall means you have to do something. So in any of the codes where you see the word shall, just bear in mind that you are obliged to do this. So the new version of SANS has some new items in it that weren't covered in the previous version. One of these is exploration target, which is a statement or an estimate of the exploration potential of a coal deposit in your defined geological setting for which there's been insufficient exploration to estimate inventory coal or a coal resource. So it's telling the reader what you expect to find. Coal exploration results, that's data and information that is generated by your exploration program, frequently a drilling program, that might be of use to an investor, but you cannot give them an estimate of the tonnage or the coal quality from your exploration results. So you would report, I've drilled 5 boreholes, you know, they're this deep, this is where they're located, this is what they intersected, this is the quality of the coal, but you never mention the amount of tons that you're hoping to get out of it. Inventory coal is something that has been around for a while, but is no longer recognized by the SAMREC code, and you may not include it or present it in public reports. So it is coal in the ground. You can estimate a tonnage out of it. You do apply some of your modifying factors, but not quite as rigorously as you would do if, for example, you're convinced you've got a resource. So it does not have to meet your RPEE standards. And like ordinary resources, it's divided into reconnaissance, inferred, indicated, and measured inventory coal categories. The reconnaissance category, which we used to report on, has moved from coal resources into inventory coal, and we may not report that one publicly anymore. We have in Southern Africa, we've got 2 main types of coal deposits. The most common one is what we find in the Witbank, the Highveld coalfields, and it's what is termed the multiple seam coal deposit type. And just to summarize, you basically have thin coal seams separated by thick interburdens, and that's relatively speaking, of course. Your coal seams are anywhere between about 1/2 meter, which is a definition for a seam, to about 7 meters thick, sometimes slightly more. And the interburden thicknesses are significantly different. As in with all coal deposits, your raw ash content needs to be less than 50%, otherwise it doesn't meet the definition of coal. The other main type that we have is what is commonly found up in the Waterberg or the Soutpansberg, the top of the Soutpansberg. And here you have a succession of interlayered coal and non-coal layers that are fairly thin, each layer, so they're probably on a decimeter scale as opposed to a meter scale, and the entire deposit can be anywhere between 40 to 70, sometimes even thicker, meters thick. Commonly referred to as the barcode deposit, and the example below shows you very graphically what we mean by a barcode deposit. The definition for the coal here is less than 65% raw ash, and that is simply because of the amount of clastic sediments that's interbedded with the carbonaceous coal, usually a mudstone, not always. So the top of the Waterberg coalfield would be called a thick interbedded coal deposit, whereas the lower part is actually a multiple seam coal deposit type. In SANS, we use drill hole spacing as a proxy for data density. And it's used in conjunction with all your other geological data. So your mapping, your remote sensing, your geophysics, whether that's aerial geophysics or downhole geophysics, trenching that you might have done. All those go together, and you include that with your drill hole spacing to get a feel for the density of data you have. And obviously, the more dense your data, the more reliable your resource estimates are likely to be. We have slight differences in the drill hole spacing between the two coal deposit types. So your multiple seam, in other words, your Witbank-Highveld seams, we look at 8 drill holes per 100 hectares for measured, so spacing of equal or less than 350 meters between drill holes. Indicated is 500 meters and inferred is 1,000 meters. Now, if we contrast that with a thick interbedded seam coal deposit, the measured there is 500. So it's more or less the same as indicated in a Witbank style deposit. Inferred is 1,000 meters, so corresponding to inferred with a multiple seam deposit type, whereas the inferred is 3,000 meters between your drill holes. I've got reconnaissance there in bracket. As I said, not publicly reported, but for your own company's records, very useful. And those are the guidelines for your drill hole spacing for those. The two little diagrams below try and compare these distances. They're both done at the same scale so that you can see how things vary. And the reason for the increased distance is thick interbedded deposit is simply because of all that plastic material in your coal. So what is a coal resource? It's coal of economic interest in or on the Earth's crust in such form, quality, and quantity that there are reasonable prospects for eventual economic extraction. And like all other minerals, this RPEEE plays a very strong role in what we report. There are reasonable expectations that this coal can be economically mineable or extractable to produce either a raw or a beneficiated coal saleable product. And this raw or beneficiated is key because it influences the type of data that you need. So if you're going to mine your coal and sell it straight to your user without any beneficiation, then it's called a raw coal product. If you need to process it in any way, even if that's just a case of destoning it, then it's a beneficiated coal product and you need a specific sort of data for that. The things you need to consider when you're evaluating the RPEEE is how thick is that seam and how far below the surface. That obviously is going to govern your mining method that you need to take into consideration. What are your key coal quality parameters? Are you selling this coal as a thermal coal and so your energy content is key? Is the ash important for whichever procedure you're going to subject this coal to? Or are things like sulfur or phosphorus very important? Those become your key qualities. What is your theoretical product yield? Now that's the theoretical yield that you get back from the laboratory. Nothing to do with the coal processing plant at this stage. And what is the quality that you are targeting in your saleable product? You also need to consider your surface infrastructure so that you can evaluate the logistics of getting this coal to market. And what are your natural and man-made features in the area? Then the last thing which you need to consider is the time period over which your extraction is possible. Is this a short-term operation, so you're probably going to go for a mining permit, or is it something longer-term where you would need a mining license? We have two types of points of observation that we use when evaluating our deposits, physical and quality. So a physical one is simply a coordinated point in space, your XYZ, plus your coal seam thickness. Now your point in space could come from a drill hole, or it could come from something like trenching. A quality point of observation, two types. One for raw coal, which ties into the point above about your saleable coal product, and one for wash coal. And you must consider those two independently depending on what your saleable coal product is. So if you are going to wash your coal, say in a dense medium beneficiation plant, you will need a wash table before you can evaluate what your coal product could possibly be and whether that coal product is going to be economic. And that all ties back into your RPEEE. Conversion factors are something very similar to modifying factors, but they're just a lot more conceptual in nature. And that is used to convert inventory coal through to resources and exploration results to inventory coal. A note on the reporting basis, and this is a moisture reporting basis and a density reporting basis. The technically correct basis for reporting is in situ moisture and in situ density. But in South Africa, we tend not to use those terms. We tend to analyze our coal on what's called an air-dried basis, and we report on that air-dried basis. Some reporting codes, for example, the JORC code, insist that you do use the in situ density simply because of the volume of historical data and the way coal is analyzed in South Africa being air-dried. We decided that we should allow reporting on an air-dry basis, but we must just state it. So as long as you state up front, this is on an air-dried basis, nobody's going to come back to you and tell you, well, you know, you reported this wrong because it's not on your in situ density. So what's in situ density? It's the adjusted density that you derive from the laboratory determined relative density, which could be either true or apparent, and you adjust it from the as analyzed moisture content to the equivalent in situ bed moisture content. It's fairly complex. It's not, these analyses are not things that are done routine, they're not done commonly, and you would adjust your moisture content by using this Preston and Sanders formula. It's a change of moisture basis methodology, which is easy to do if you've got the data. The difficulty is we have very little of this data in South Africa. Right, I'm going to now just run through the various resource reporting categories, starting with that we know the least about, which is your inferred coal resource. And it needs a minimum of 1 cored borehole with quality data per 100 hectares or per 1,000 hectares, depending which coal deposit type you're using. When I say quality data, I'm now going back to, is it raw or wash data that I need? And that depends on what you intend to sell. We always look at coal in the full seam thickness above whatever your minimum thickness cutoff is. So you must have at least a 0.5 meter minimum thickness cutoff simply because of the definition of coal. But in your particular mining operation, you might have made a decision that we're not going to mine any coal less than, for example, 1 meter. So you would apply your minimum thickness cutoff here, and your relevant coal quality cutoffs are things like your CV and your ash, and volatiles is another common one. You need to consider your RPEEE. And you know about the tonnage, the density, sort of the rough shape of your deposit, its physical characteristics in terms of thickness and extent, as well as the quality, but not with any high level of confidence at all. It's a low level of confidence, and you assume the physical continuity, but you don't need to make any assumptions about the coal continuity, because at this stage you might not have enough information. All these resource categories, you get your information from things such as your outcrops, very rare in South Africa, trenching pits, old workings. You can use information from that as long as you are sure that that data is rigorous, and your drill hole information. The best thing to do is to put approximately in front of your tonnage estimate and use that to try and convey your low level of confidence. We also ask you to look at significant figures for your tonnage estimates, just so that you don't try or inadvertently convey a level of precision that you actually can't have with this category. So usually with an inferred coal resource, you don't even do a pre-feasibility study. You just don't have enough information for it. However, if you look at an indicated coal resource, your level of confidence is significantly higher. That's because you have more data. So we're asking you to have 4 boreholes for every, or drill holes rather, for every 100 hectare, or 1 drill hole in the thick interbedded seam deposit type. The thickness cutoff is exactly the same as for an inferred resource. You've also considered your RPEEE, and in this case, you have a moderate level of confidence about your deposit. you've confirmed your physical continuity, but you're still assuming coal quality continuity. There's slightly less restrictions on your significant figures, and this again reflects your level of confidence. And in this case, it is sufficient to justify a pre-feasibility study. There's a little note up at the top right-hand part of the screen. Drill holes must be relatively evenly spaced over the area. I'll show you a diagram shortly that shows you what I mean, but I wouldn't like anybody to use a cluster of boreholes down in one corner of their prospecting right area and extrapolate their tonnages over the entire area. Just going on to our last category, the measured coal resource. We're looking for 8 cored drill holes with quality data, raw and or washability data, every 100 hectares for your multiple seam coal deposit type, so Witbank Highveld type, but only 4 for your thick interbedded seam deposits, so Upper Waterberg and Upper Soutpansberg. We have a high level of confidence in our coal tonnage, both in terms of physical and quality continuity, so we can confirm it, both of those characteristics. We've got detailed and reliable exploration, sampling and testing information, again, through a variety of data sources. And when I refer to reliable testing information, in particular, your laboratory analysis. Again, some guidelines for your significant figures. And in this case, our confidence is high enough that we can justify a feasibility study. Here's the diagram I was referring to about the distribution of your boreholes. If you look on the left-hand side of the screen, you can see there's a fairly nicely arranged cluster of boreholes with a line indicating the limit of your coal deposit and very little data on the other side of that line. You do have one drill hole, but it didn't intersect any coal. All the drill holes that have got the dark circles around them have intersected coal. Our little cluster in the middle, we can definitely get a measured resource out of that, as well as indicated and inferred categories. But then to the southwest, we've got a line of 3 boreholes. That is not a resource, because we can not get any spatial confirmation out of a linear arrangement of drill holes. Those holes need to be in sort of a triangular shape for us to use them to define a resource. And then the one borehole that's off by itself up in the northwest, that again is not a resource because it is isolated. This diagram on the left is what people often refer to as the spotted dog. And in the old days, some of the software used to categorize your resources that way, and that is incorrect. If we look on the right-hand side, we've got some resulting polygons around there. Now I've used the traffic light colors, inferred red, indicated orange, and measured is green. So I've just sort of roughly drawn a polygon shape around that. You'd be a little bit practical with this. You're not going to follow the curves of the circles on the left directly. But again, you're not going to include huge areas of, for example, inferred in your measured category. Just in summary, your categories of coal resources would be reconnaissance, inferred, indicated, of measured, of which only the last 3 are reportable. Your confidence increases as you go down that table, and the integrity of your data does likewise. And your continuity moves from assumed through to confirmed, so that when you get to measured, you're really very comfortable with what you know about this deposit. Your classification is based on your lowest matching criteria at all times. And again, reconnaissance is only inventory coal, whereas the other categories are coal resources. And your coal quality type depends on the marketing of your coal. So you need to know what you're going to sell your client. In terms of resource reporting, we only report mineable in situ tons according to SAMREC. Although in estimating our resources, we work through the categories gross tons in situ, which is your full coal seam thickness in the ground, through total tons in situ, where we've applied our geological loss, to mineable tons in situ. And the critical thing here is that you apply your theoretical mining seam thickness. So that's often, say for underground, it's between 1.5 and 4.5 meters, something along those lines. If you're looking at an open cast deposit, you're looking for depth cutoff and strip ratio cutoffs. And it's only once you've applied these factors that take some sort of mining into account that you have a number that you can report according to SAMREC. Your maximum and minimum seam thickness and coal quality cutoffs apply to all your coal resources, and you must report them raw and or product coal where you expect to beneficiate them, and you must state on what basis you are quoting your resources. And we've discussed already about the air-dried basis. A theoretical mining height, in the case of an open cast deposit, is generally the full height of the coal seam. It might be a case that you're doing selective mining and that you're only going to be mining some of it, but that tends to apply more in the underground scenario. You would include in this any parting material that you can define. So in other words, you can correlate your parting, but it doesn't include any planned dilution, because that's a mining thing and that applies far more to reserves. The theoretical product yield is your laboratory estimate of your target product yield. So we look at the density separation there and the size separation, or both of them, depending on your product, at a specific coal quality, or what we call a cut point density, one of the two. So we either wash for quality, calorific value, or we wash at a density at whatever our coal particle size range is, on an undiluted, uncontaminated basis. So here I've got in big red box at the bottom that your public reporting is on an MTIS basis only, and the key to MTIS is you've applied your theoretical mining height. When you quote your resources in a public document, you can't quote measured and indicated resources as one estimate unless you've already quoted them separately. And the reason for this is because of the measured resources translating into proved reserves and indicated translating into probable reserves. And of course, you can't combine inferred with either of the two. So reconnaissance inventory coal is only estimated as inventory. It's not publicly reported. It's for your own internal company use only. You've only got one borehole or drill hole per 400 hectares or 1,600 hectares. Again, you're looking at the full seam and you're assuming physical continuity, very low level of confidence, and you have limited coal quality data. Just moving from coal exploration results all the way through to coal reserves, this diagram, which is based on the SAMREC diagram, starts off on the left-hand side with your exploration results. They're all inventory coal and they're divided into those 4 categories: reconnaissance, inferred, indicated measures, which indicate an increasing level of geological knowledge and confidence as you move down this table. Then we can move these categories into true coal resources when we evaluate the RPEE. So inventory coal inferred becomes coal resource inferred, and again, it's mineable tons in situ. Those 3 resource categories move over into coal reserves when we apply our modifying factors, and as indicated there, measured gives you your proved reserve, or some cases you might put some of your measured resources into probable reserves, but indicated can only go into probable reserves. And I've got there ROM. There are 2 bases for reporting reserves, and one of them is run of mine. So your reserves, your run of mine reserves then translate into your saleable reserves. When you quote in public reports, you must quote your coal resources plus your coal reserves on both a run of mine and a saleable basis. This diagram is identical to figure 1 in SAMREC. The only difference is we have changed the word mineral to the word coal, and otherwise it's identical. Okay, now I'm going to tell you a little bit about coal reserves. So to move from a coal resource to a coal reserve, we need to apply modifying factors. So we use these in things like feasibility studies, and we would consider the geotechnical aspects, mining, the coal qualities. Is it, a quality that somebody is interested in buying? How are we going to process this? What is the infrastructure around our deposit like? What are the economic considerations? What marketing is required? Are there any legal obstacles? We need to consider the environmental aspects, particularly things like water bodies, and the social and governmental factors around the area. When doing table 1, we've got to consider all these modifying factors individually. And if it's not particularly relevant to the current assessment, so your particular project, then just justify it again on this if not, why not basis. A coal reserve is your economically mineable part of a measured or indicated coal resource, and it will include your dilution and contaminating materials. And it also makes allowance for losses which may occur when the material is mined or processed, and the mining is planned, and is defined by studies at pre-feas or feasibility level, and include your modifying factors, and must demonstrate or shall demonstrate at the time of reporting that extraction could be reasonably justified. So a coal reserve derived from a mineable in situ indicated or measured coal resource. It includes your dilution, contamination, losses, and moisture correction factors. And you derive these by applying your modifying factors. That you also need to be sure that your extraction is reasonably justified, your deposit is economically mineable, and you show that in either a pre-feas or feasibility study or life of mine plan if you're currently in operation. A probable coal reserve is derived from your indicated coal resources. Which come from your measured coal resources, and you have a moderate level of confidence in your modifying factors. So your estimation, therefore, has a moderate level of confidence. A proved coal reserve only comes from your measured coal resources, that you have a high level of confidence in both the modifying factors and therefore the resource estimate. And it's no longer a feature of the SANS document as well as SAMREC that you must have a feasibility study. A pre-feasibility study is sufficient. You cannot combine your probable and proved coal reserve estimates in one figure unless you've already stated them separately. So that's very similar to your measured and your indicated coal resources. Your coal reserve reporting categories, the only ones that you can publicly report are your run of mine and your saleable. Those are the two in bold type on this slide. The steps that you go through in the estimation, starting from the top of this slide, would be your mineable tons in situ, your theoretical mining height. So that's as the numbers come over from the coal resources, you then apply practical mining factors like the height, the dilution, and that gives you your mineable tons in situ to a practical mining height. And from that, you get to your extractable tons in situ, because there you've applied your mining layout factors. For example, you're unlikely to get into the very corners of your deposit. It's just not going to be practical or economic to mine out small corners with big machinery. So your losses get accounted for in this category. However, you only report this run of mine where you've taken your contamination, your mining recovery efficiency factor. In other words, how much of the coal that you plan to get out did you actually get out, and you apply your run of mine moisture correction factor. Your saleable reserves, you have applied your practical product yield, which is not quite the same as your theoretical product yield. So A theoretical product yield comes from a laboratory analysis. A practical product yield comes from the plant itself. And you again apply a moisture correction factor. This is for your saleable product. Public reporting of coal reserves has to be on both those bases. You can't do one or the other, and you would report them very clearly and very separately. And just again a note that MTIS coal reserve can no longer be publicly reported. That was possible beforehand, but it no longer is. So in terms of your reporting categories, you've got to have a mine plan before you can estimate a reserve, and you've got to have decided on the mining method that's going to apply. You need to know what your minimum and maximum mineable thickness are, and that's tied in with the machinery that you plan to use. And you also need to know exactly what your coal quality cutoffs are, and that's tied in with what you're planning to sell. Your practical mining height, it's either the height of the full coal seam, as is common in an open cast operation, or it's the optimal selected part of the coal seam. In other words, your mining horizon that you expect to mine, and that includes any planned dilution material. So dilution material is generally non-coal material or coal material that does not meet your quality specifications, but that you plan to mine to either give you access to another area or to be able to take your full mining height into account. Your run-of-mine coal reserves on an as-delivered basis, which are a specific public reporting requirement, contain contamination. And contamination is non-coal or out-of-spec coal that you mined without planning to. So it's an inadvertent mining of material that is not coal, and you also apply your moisture correction factors. Your practical product yield, which is your net product yield of a target product. In other words, whatever you put in, the percentage of what you put into the plant compared with what comes out the plant at the other end once your beneficiation has been done. And usually that's a density separation and sometimes also a size separation. We say here preferably on an air-dried basis, and that's simply because in South Africa, that's the way we tend to work. We don't tend to work on other bases that often. If you're going to sell your saleable coal reserves raw, so unbeneficiation, your practical product yield is 100%. The quality must be reported per product type. So if, for example, you are selling a primary product to the export market and your middlings are going to be sold locally as a domestic product, you've got to report those two separately. You will also report both of those on either on a run-of-mine and a saleable coal reserve basis, and with each of those estimates comes their yield, the coal quality, and the moisture contents. So other potentially economic coal, just to sort of backtrack and give you a rationale reminder, a coal resource is coal of economic interest in or on the Earth's crust. Now, by on, I don't mean that it's naturally occurring lying around there. It's highly unlikely. But we have mined some coal and already piled it up on surface in the form of what we used to refer to as dumps. And maybe we're going to go back and mine those. In fact, there's quite a lot of that going on these days. So just in terms of location, coal is either in situ. So it's now sitting in your remnants or pillars. You've mined your main part of your deposit, so your resources have been mined, and what's left are little corners that you haven't mined, plus pillars in an underground situation. Coal on surface we refer to as residue coal. It's either in discard or reject coal stockpiles or low-grade stockpiles, which is what we always used to call dumps, and tailings deposits. So the remainder of your deposit after you've washed it. Coal in remnants and pillars come from previously mined underground workings, and these days are potentially economic simply because now we can mine and use lower grade coal than historically, and our machinery is so much better. So in the old days, if your coal was 10, 15 meters underground, you had to mine it using underground methods. So the old collieries in the Witbank area, whereas these days we can mine stuff open cast down to about 150 meters. So we can go back and we can pick up all these remnants and pillars. However, until you have actually planned your extraction, this coal needs to stay in your inventory coal. The moment you've planned it, and you can only plan it once you've figured out that it is actually going to be economic, then you would redefine these resources into your coal resources, apply your modifying factors, and then you can move them into coal reserves. So to move coal from remnants and pillars into coal resources, you define your extraction plan. To move it into the reserves, you've got to do additional assessments, which includes a detailed mining plan. Then you get something called residue coal. So it's coal or carbonaceous material that may or may not have plastic material or stone in it. And it's the result of mining or coal processing. And those coal qualities currently fall outside of your saleable product range. So you wash your coal, your middlings all go on a dump basically. And at the moment you can't do anything with it because nobody wants it. However, in time to come, it's quite possible that people can use that coal, and then you would consider it as a coal resource. So yet again, you leave it in your inventory coal until you plan to extract it by remining a dump or a slimes dam, tailings deposit. Then you redefine it to your coal reserves. And you can go a step further. You can say, well, okay, I plan to mine this deposit. I'm going to process the coal. There will be residue from this coal processing that at the moment I'm not going to be able to mine, but not going to be able to sell, but in future will probably be able to sell, and I will probably be able to report it as a coal resource. I must confess that I struggle a little bit with this one, getting my head around it. Probably it's just because I can't see far enough into the future to convince myself that this can be done. Stockpiles and low-grade stockpiles or dumps or mineral residue deposits, another term that people use, are included in your inventory coal until you've planned your extraction, and then you move them over into your resources or your reserve categories. And this covers, residue coal basically covers everything that's left on the surface as opposed to in situ coal, which is still underground. That is the end of my talk. Just a little note that SANS, I see I've got a mistake here, 10/3/2004, it should be 2020, is copyrighted, and you can purchase your own copy at those addresses below. Thank you very much. I did find this a little bit difficult presenting on Zoom for the first time, so I hope I conveyed everything that I needed to. Thanks all.
Thanks, Les. You actually did extremely well for your first time in Zoom. Are there any questions for Leslie?
I've either bored them to tears, Tanya, or they've gone and got some coffee, or I've confused them totally.
No, I know I got confused totally.
Leslie, Thomas here.
Yes, Thomas.
Leslie, I just wanted to double check about the category, that classification. You know, we generally using 350 for measured in the Witbank Highveld area, like you said.
Yes.
And usually we plot just the radius of those holes, which if you take it directly, it's 175.
That's a radius that you're talking about, not the distance between the two. I tell you what some companies do is they look at the aerial distribution. So, you know, your 4 boreholes a hectare and that sort of thing. and they work out what the radius should be there. If you just do it on an actual borehole spacing, one borehole directly to the next, it's 350 meters.
Yes, I wanted to check the radius there. That 175 will be the radius, am I right?
I have seen
let's say
calculations at 199, but that is not the SANS basis. So you need to use your 350 between them to be correct according to SANS and therefore according to SAMREC.
Yes, I have seen as well, that's why actually I was asking, I have seen where we use 190, I think it's 197.5.
Yeah.
And
Thomas, that is a company thing. It's not a public reporting thing.
Okay.
To be strictly correct for public reporting, you need to use the 350, the 500, the 1,000 meters.
Okay. But the 350 is actually the diameter, not the radius, am I right?
It should
From
be,
the
yeah.
point of observation.
Yes, yes.
All right.
Which is where you get your 175 from. You're just halving it.
Yes, yes, yes.
Okay, but if you take that diagonally, if you have a grid of boreholes that are 350 meters apart in all four cardinal directions, now take the diagonal between these boreholes. The 175 is going to give you a little hole in the middle, a little sort of funny cross-shaped thing. So some people use 199 so that they get rid of that little cross-shaped thing. So in other words, you're going to have overlapping circles of influence. To be quite honest, my personal view is that tiny little bit in the middle is really not significant if you take it in terms of that area combined with or compared with the area that you would classify as measured.
Okay.
I also don't believe, you know, that you have to stick with these numbers rigorously. So maybe you've got 300 meters between your boreholes and maybe you've got 370 meters between your boreholes. But if you are in an area where your physical and your quality continuity is assured, you know, it's a very stable deposit, you know what's happening, there's no faulting, there's no dolerite intrusions, there's no washouts. As long as you state that because of the nature of this deposit, you are happy to use a slightly bigger borehole spacing, that's fine. It's kind of the if not, why not, you know. And remember that the CP is the one that has final responsibility. You have to be able to stand up in front of your peers and justify why you're using something slightly different to what the code says. Does that sort of explain things to you?
Yes, yes, no, that's clear. I actually wanted to get the clarity. I thought the 197 was the SAMREC thing, but now I'm clear that it's just a company thing. Okay,
just a word to everybody out there that does coal reporting. Please go and get your new version of SANS 2020, and then you will see all those numbers are there for you. It shows you, it's got two parts to the document. The first part is a SAMREC document, and the second part is what we call the how-to. So how to estimate your resources, what sort of analyses you need to do for what sort of coal product. So it's more of an educational section, let's call it, rather than the strictly public reporting section, the first part of the document. There's also lots of definitions up at the front, which I encourage people to go and have a look at, because often one assumes that you know what something is, then you go and read the definition and then you find that actually it's slightly different to what you thought it was. So it's very useful from that point of view to make sure that you are understanding things correctly, so that when you report publicly, you are reporting correctly. Are there any other questions?
We had one from Gary. Gary, you had your hand up a moment ago.
Yes. Hi, Leslie. Just
Gary.
a quick question. There's possibly a lifetime of answering. Having spent many years sampling dumps, stockpiles, have you ever, you talk very glibly that you can actually, from what I hear, get a very reliable answer out of sampling broken ore, basically.
No, not at all. I was trying to gloss over it. It's not easy, particularly something like density, but even your qualities to try, and you're never going to get an answer that's correct. The best you can hope for is as little incorrect as possible, simply because of the way dumps have been constructed, sometimes with forethought and sometimes without, and sometimes on a bad day. So I sympathize with you.
I've never found one constructed with forethought.
I think in the planning stage, those kind of things happen, and then real life happens.
Yeah. Okay. I just thought there was something special about coal.
No, it's not a nice job to have to do and come up with a number that you're willing to stake your life on.
Well, you just blend it in with some good stuff.
No comment.
Okay then, thank you.
Okay, Neil, would you like to ask your question, please? Leslie, you can unshare your screen if you wish.
Unshare my screen.
Unshare.
Thank you. Thank you very much for the presentation, Leslie. I found it very informative. Leslie, could I ask this question, and maybe if the earlier speakers, if they're still signed in, they could maybe help us understand a little bit about this. My question revolves around what is the shelf life of a CPR? How often should you go back to it? Because projects tend to, because you spend so much money on this thing, the project typically gets flogged. So your prospecting right is, let's call it 5 years, 8 years in duration. So does your CPR then live that long? Or is there a shelf life and you have to redo it from scratch again? Now, I asked this in the context of the question that I've put into the chat on the side there. So Mpumalanga has now declared itself an open cost free mining zone. Okay, so they said in terms of the biodiversity regulations that they've promulgated, that no new open cast mines may be established. So clearly, if I have an open cast coal mine that I want to establish there, I now need to suddenly revisit my CPR, and now I have to redesign my mine for underground. So I'm trying to understand what is the shelf life in the coal space, or in the diamond space, or in any space of a CPR, whether Ken or yourself or Tanya might know the answer for your sense. I heard you say 6 months, but then can you also then explain why 6 months only?
Okay, six months is one of the Chapter 12 rules in the JSE listing rules. So from your effective date, say your effective date is, I don't know, 30th of September this year, your CPR is only valid till the 31st of March next year. And you would need to redo it if you need to use it again. So it might be that you actually don't need a CPR for whatever it is your company is doing for another couple of years. So you don't have to do it until it's necessary. Your company might have particular in-house regulations that it has to be done every 12 months. But I do know of some companies that don't do a CPR until necessary. So if you're listed on the JSE, you would need to annually produce a report detailing your resources and reserves, and those need to be backed up by a CPR. Okay, but the CPR itself is only valid for 6 months. And in terms of, do you need to do it from scratch? No, you can update it. So if nothing has changed, your geology, for example, hasn't changed, but you've done additional drilling, you would include your additional drilling in your resource estimates. Or if you've done some mining, you would deplete your resources according to that mining as well as your reserves. if you suddenly discovered there was some horrendous dolerite intrusion that you managed to miss beforehand and it had burnt a whole lot of your coal, well, you'd obviously include that. If there had been any major changes, for example, you were selling the coal raw and now you've moved into an area of the deposit where the qualities are not so great, but if you washed it, you could get a good product out of it. You'd need to take that into account. So you really only need to include the changes. So anything that is material in allowing somebody to properly understand what your deposit and or operation is doing is what you need to consider. Does that answer it well enough for you?
Thank you, ma'am. It does answer for part of what you're saying. So if it's 6 months, I don't know then why should you be doing it annually and not biannually, you know, and doing it.
Well, if you don't need to do it, you don't do it. So example, if you're going to list, you need a CPR, it has an effective date. You list before that date expires and you're allowed to carry on with your listing. You then don't need it again until you have to report your results to the JSE 12 months later, in which case you need to have updated your CPR. But there might be no need for a CPR in those 12 months other than the listing. So don't do it every 6 months. Don't spend that time and effort and money to do it. Do it when necessary. I tell you what does often happen. You do a CPR for the JSE, you submit it to the JSE, you do your listing, and it takes so long to happen that your CPR is now out of date and you have to update your CPR before you can continue with the listing. That's happened to me a couple of times.
Thank you, ma'am.
Can I just pitch in there, Neil, remember that a resource or reserve is dated. So the date represents the summary of knowledge at the time and the interpretation. And particularly when it comes to reserve, it also implies cost parameters. So if those things change, then you will need to revise them. One of the things that I've seen happen is where a company has not done any work and nothing has changed for a number of years, and they keep republishing the details of the resource and reserve, and after 4 or 5 years, it's actually out of date. And you run potentially foul of actually having a legitimate resource or reserve. As far as the CPR is concerned, the CPR is really only a summary of the information. I don't think you would, every time you do a resource estimation, you need to have a CPR. Having a summary of what you've done in some documented form is fine. A CPR, full CPR with all the bells and whistles, probably not required every time you do a resource estimate.
No, not every time you do a resource estimation, but every time you submit something to the JSE, it needs to be within that 6-month period.
Correct. So if you're working outside of the JSE regulations, as in a private company or in some other way, a lot of those things then are on the basis of the CP's understanding and or the company directors.
Thank you, Ken.
Do we have any questions for any of our speakers? Going once, going twice, sold. Okay, folks, thank you all very much for joining us today. We hope to see you all back next week. Same time, same login details. And then we will be listening mostly to Ken talking about the competent person and SAMREC Table 1, and also the SAMESG guidelines on ESG issues. Thank you all. Enjoy the week, and we'll see you again soon.
Thank you. Goodbye.
Thanks. Bye.
Thanks, John.
Thank you. Bye.